Good morning. We have a panel that is focused on the issues raised by the proposal of Auditor's responsibility for other information. And it's a highly qualified panel, but before I introduce people, a bit of news from the front. We're advised by Nathalie Berger of the EU that the European reform proposals, which were summarized so ably in Sven Kettner's materials yesterday, in which he discussed in detail, were passed by the European Parliament this morning. So they're now law in the EU with the overarching subject to the country. A member state is free to have a more restrictive or a stronger policy. The panel, as I said, has extraordinary qualifications. Jeremy Perrier is the Director of Research at Shillett Forensics, and he's the co-author of Financial Shenanigans, How to Detect Accounting Gimmicks and Fraud in Financial Reports. It's gone through 3 editions in 2010. Previously, he served as the in-house forensic accounting analyst for Co2 Management, a long-short equity hedge fund, Director of Research for CFRA, Auditor of PricewaterhouseCoopers. He served on the FASB's Financial Accounting Standards Advisory Council as a representative of the investor community. Michael Young, litigation partner at Wilkie Farr & Gallagher, whose practice concentrates on securities and financial reporting with a particular emphasis in accounting issues. He's also chairman of the Financial Reporting Committee of the New York City Bar Association. He is chair of the firm's securities litigation and enforcement practice. His trial work has included financial reporting matters in federal, state, and bankruptcy courts throughout the United States. His experience includes the landmark jury verdict for the defense in the first securities class action tried before a jury pursuant to the Private Securities Litigation Reform Act of 1995. He previously served as a member of the Financial Accounting Standards Advisory Council. He is chair of the Financial Reporting Committee of the New York City Bar, and he's counsel to the AICPA and the Center for Audit Quality. Michael has a distinguished record in this area that is second to none, and he's going to have a lot to say. Peter Notchway is Chief Financial Officer at Legg Mason, a member of the firm's executive committee. He's responsible for the areas of finance, investor relations, corporate communications, human resources, operations, and technology. Previously, he was Managing Director and Chief Financial Officer of the Carlyle Group. Prior to joining Carlyle, he was a partner at Deloitte & Touche, served as the Northeast Regional Managing Partner for the investment management industry. He is a current member of the PCAOB's Investor Advisory Group. Mike Gallagher, Managing Partner for Assurance Quality at PwC. He supervises national office efforts in the areas of accounting services, U.S. Securities and Exchange Commission services, risk management, strategic thought leadership, auditing services, auditing methodology. He's also responsible for PwC's Audit Transformation Program, Learning and Development, Regulatory Relations, and Inspections Groups. He currently serves as the chair for the Center of Audit Quality's Professional Practice Executive Committee. He is a current member of the PCAOB Standing Advisory Group. Gentlemen, welcome. Jeremy, the floor is yours. Thank you.
Good morning. And thank you for having me on this distinguished panel. I'm delighted to be here today. It's a great honor to speak with you and share my perspectives on a topic as important as other information and the auditor's role in financial reporting. Now, thank you, Chairman Doty, for that nice introduction. If I may, I'd like to add a little bit more context on my background, as I believe it to be helpful in understanding how my perspectives as a financial statement user have been framed. I've spent the last 17 years studying and analyzing companies who employ aggressive accounting and manipulative reporting tactics to embellish their financial performance. My current role as an advisor to asset managers is at a forensic accounting consultancy called Shillett Forensics. We advise well-regarded investment firms. They engage us to unravel complexities and uncover misrepresentations in the accounting and financial reporting of their portfolio companies. Now, over the years, I've had the pleasure of working with and advising hundreds of asset managers on the accounting and reporting practices of their portfolio companies. So my perspectives today are based not just on being a power financial statement user myself, but on my daily conversations with these investors. From these interactions, I gained a strong understanding of relevancy and how financial information is consumed and used in the investment decision-making process. Now, the topic of other information is an extremely important one, and I commend the board for its efforts to increase auditor scrutiny to areas beyond the financial statements. It speaks to what is, to me, the biggest problem facing financial reporting today, the growing dissonance between audited financial results and the key performance metrics showcased by management. This is a weak spot in our financial reporting system that allows issuers to bypass the traditional audited financial statements and engage in an unscrutinized parallel conversation with investors. By not participating in this conversation, the audit function is weakened and investors are worse off. Indeed, the traditional audited financial statements are becoming less relevant as an investor communication tool. It has been commonplace for management to present self-made, non-GAAP metrics as more relevant proxies for earnings and cash flow performance. These metrics are delivered to investors in earnings releases, PowerPoint presentations, as well as the MD&A and other places outside the financial statements. And it is usually the case that these metrics are the most important data points and disclosures to the investment community. Often these metrics make sense and provide very helpful insight into a company's operations. For example, same-store sales for a retailer, organic growth for an acquirer, or earnings excluding a large litigation settlement. However, in many cases they don't, like something called steady-state free cash flow before special items, and the laughable adjusted cash EBITDA less one-time items. However, in all cases, regardless of their legitimacy, these metrics are unaudited and susceptible to the whims of management discretion in definition and disclosure. For example, when EBITDA is no longer flattering, it becomes adjusted EBITDA, and then adjusted cash EBITDA, and finally adjusted cash EBITDA less one-time items. And even in cases where the metrics seem commonplace and logical, they are easy to redefine as needed. For example, determining which stores are included in same-store sales is rife with discretion. Relying on management to self-police these important metrics is insufficient, just as it is insufficient for traditional GAAP measures. To be clear, the issue here is not whether a company is honest or disingenuous about these disclosures. Rather, it is that these supremely important disclosures and data points are not being scrutinized by auditors, a point which is generally lost on investors. This is where I believe the board's proposals on other information are helpful. The current financial reporting paradigm promotes this environment in which many of the most important metrics to investors are widely unchecked. Enhancing auditor responsibility over this information by, as the board proposes, requiring the evaluation of these disclosures with a focus on material inconsistencies and material misstatements is common sense and will no doubt strengthen and add robustness to our financial reporting system and ultimately lead to fewer cases of willful or negligent misrepresentation. I recognize that evaluative scrutiny likely means added procedures. However, the benefits to investor protection and public disclosure far outweigh the costs. The flow of information from companies to investors has changed, and so too should the auditor's responsibilities. Naturally, I would like to see more steps taken to rein in the mass promotion and dissemination of unscrutinized information, but I recognize that many of these efforts would be beyond this board's jurisdiction. However, I believe this board's proposal regarding other information shows leadership and is a very positive step that will have a powerful impact with regard to protecting investors and promoting more reliable and representative financial disclosures. Thank you for the opportunity to participate in this conversation, and I look forward to our discussion.
Thank you. Mr. Young.
Well, I am exceedingly sympathetic to the desire of investors for better information. Like a lot of people in this room, I am reading 10-Ks all the time, and they have gotten to be as dry as dust. And what is particularly frustrating, as I think about it, is that it does not have to be like that. It is theoretically possible to write about things, to write about business things, even with all of the rules and the regulations and all of that, it is theoretically possible to write about things in a way that is understandable and informative and interesting. And at the risk of sounding trite and saying the obvious, I would offer that perhaps the best illustration of that is the annual shareholder letter of Warren Buffett. It is interesting, it is understandable, you get the sense of what's going on within his companies, the challenges, the triumphs, the failures. And the question for me is, how can we get people to write like Warren Buffett? Boiling it down. My concern with the other information proposed standard is that it doesn't get us there. And in fact, my concern is that it may take us in the opposite direction. Now, let me explain why. The board has asked me to focus on how the standard will be interpreted and applied. And that is actually the root of my concern. Under this standard, I would expect auditors to find themselves being held fully accountable for other information. They will be evaluating the information. They will be speaking to its truthfulness. And if the information turns out to be false, they will have some explaining to do. And even if they are able to point to the standard and to say, well, we missed the false statement, but look at the standard, we complied with the standard, that, to my way of thinking, does not satisfactorily mitigate the concern, because historically, where auditors have missed a false statement, insistence on in compliance with the applicable standard has not sufficiently mitigated the appearance of professional failure. So, as I think through how this standard will work, my own reaction is that probably two things will happen. One is that the amount of work needed to be undertaken by the auditor will need to increase commensurate with the risk, or the information will need to get easier to evaluate, or both, and I would expect both. So one consequence of the standard, as well intentioned as it is that it may create an incentive for management to draft other information in a way that is easier for the auditor to evaluate, that runs less of a risk of auditor recalcitrance. And the concern is that we will end up building into financial reporting still another incentive to favor objectively verifiable information of the sort that auditors are more comfortable with at the expense of the kind of subjective commentary that connects the dots and explains what the data means in everyday words, of the sort which may be harder for the auditor to evaluate. And to my way of thinking, that's the opposite of the direction in which we want to go. I mean, when I think of it as an investor, I think about wanting management to connect the dots. Don't just give me the data, but tell me what the data means. Tell me how you are looking at this data and what it's telling you, management, as to what it means for your past performance, what it means for your future performance, what the data means for risk. And I'm concerned that instead, under this standard, we would be headed more in the direction of disconnected, objectively verifiable data, and therefore that 10Ks, if this is possible, would even get less interesting. And I would like the record to reflect that for the first time in the history of recorded civilization, an attorney has taken less than his allotted time.
Mr. Chairman, I'd like to reserve that for my remarks.
We'll make up for it. But did you record the time? Mr. Knoxway.
Thanks, Chairman Doty, and hopefully I won't screw up the timing by using all the time he's saved us. But first of all, good morning to all of you, and thank you and the other members of the PCAOB for the opportunity to be here and speak with you today. I think the proposed standard regarding auditors reporting on their involvement in other information is of great interest to me and to my organization. But this morning I'll speak from three very different perspectives. So first, as a former audit partner with Deloitte & Touche, where I practiced for 25 years. Second, as CFO of Legg Mason, an S&P 500 company and an issuer of public company financial statements. And then finally, as a fiduciary for almost $700 billion of third-party assets under management by Legg Mason. My remarks represent my own views and do not necessarily reflect those of Legg Mason or my colleagues. So with that bit of housekeeping out of the way, let me address the proposed reporting standard, which I generally favor, but with some key caveats that I'll address in a moment. I think it's important to recognize that with this proposal, we're talking about information auditors are already required to read and consider in auditing public company financials. So I believe it is a positive step to have auditors clarify what they are currently involved with, as users of financial information very often rely on numbers outside of the financial statements. At a very high level, this proposal provides the audit profession with the opportunity to help investors and others understand what information outside of the financial statements the auditor has been involved with, and that is clearly a worthy objective. But we should be careful to comprehend the real-world implications of such changes and weigh the potential costs against benefits. In that regard, we must be very clear-eyed in understanding the value of these benefits to investors, which easily could be overstated, and we need to be thoughtful about added costs, which are ultimately borne by investors and can easily be understated. In my view, the public generally believes that auditors already verify information outside the audited financials. As a consequence, many investors have an imperfect understanding of what auditors actually do with that information. They may believe auditors are involved with any and all numbers in a company's annual report or 10K, including numbers not derived from the books and records. And of course, as all the auditors in this room will know, that is not true. But without a bit of a roadmap, how can investors be sure where the auditors have been involved? So I'll give you an example of this from the asset management industry. For firms like Legg Mason, a key performance indicator is assets under management, or AUM. AUM is generally a big number, both quantitatively and qualitatively, and we often use it as shorthand to describe the size and scale of our firms, as you may note that I just did in my intro about Legg Mason. Consequently, AUM gets significant MD&A attention by asset managers, yet the related numbers are not per se audited. However, our auditors do see our AUM numbers and perform significant work around them given their direct impact on our revenues. And I think investors would likely find value in knowing auditors have done work on these disclosures, which would provide an important check on management. The proposal also may provide the audit community at large with better leverage. Currently, there is no recourse for audit firms if they disagree with management assertions outside the financials, other than the nuclear option of pulling their audit opinion and resigning from the client. So I believe the proposal, properly structured, could promote a more useful dialogue between auditors and management. There could be other benefits as well. In stock and debt offerings, underwriters require the company's auditors to review and report on information outside the financial statements and provide them with comfort letters. If the other information is already reviewed and reported on, this could expedite and possibly lower the expense of public offerings. While I like those aspects of the current proposal, it's critically important to determine now in advance whether the potential benefits truly justify making a change, because history has shown that regulations are seldom, if ever, rolled back, owing to silly things like greater than anticipated costs. I also believe other aspects of the proposal require further review and consideration. First and foremost, we must develop a common understanding of what the word evaluate means or eliminate it from the proposal. And this I refer to both in terms of how much work the audit firm should do and how much information they should provide in their reports. If left in, I feel evaluate will cause significant additional work by auditors. The resulting expense to issuers and investors would not add commensurate value in my view. The PCAOB should make clear whether the proposal calls for auditors to do more work or simply report on the work they have already done, and I strongly advocate the latter. Further, it is unclear what other information is in scope. For example, annual reports often include a company's headcount, a disclosure the auditor is generally not involved in. Clarity around how auditors evaluate qualitative statements or assess materiality of non-financial data is also very important. Examples of these include descriptors firms frequently use to reference their industry standings, such as "we are one of the largest" or "we are one of the fastest growing." How can auditors validate those types of statements? Frankly, in my view, they cannot and should not. To the extent that information outside the audited financials is deemed part of the auditor's scope, it becomes very important to clearly identify information not within an auditor's expertise and thus not within their scope. And then, practically speaking, boilerplate language that would obviate the clarity of the PCAOB and the clarity that the PCAOB and investors seek in this area. And I think it's important to recognize that we live in one of the most litigious societies on the planet, and like it or not, boilerplate will be part of the bargain in this proposal. We should acknowledge that up front and be careful to encourage as little of it as possible. Finally, there's the cost of the reporting extension itself. Auditors will be doing more, even if it's just adding language and documentation based on existing requirements. Auditors will want to pass these costs on to their clients. Clients will also have to deal with a higher level of questions and documentation auditors will need for their files, which will require them to add headcount. Both of these costs that our investors would ultimately bear. The proposal, however, need not become onerously expensive or another giant process creator. Thus, I do not see any of my concerns here as fatal to its adoption. But I do believe the board needs to exercise proper due diligence, as it has with other initiatives, to avoid the potential pitfalls I and others have noted. I think this session is a great example of giving the regulatory community, the audit firms, and their corporate clients, like Legg Mason, time and opportunity to work through these important issues together. So I applaud the board and the staff for making this event happen, and I thank you for your kind attention.
Thank you. Mr. Gallagher.
Thank you, Chairman Doty, and members of the board and staff. I appreciate the opportunity to provide feedback today on the board's proposed auditing standards related to the auditor's reporting model and other information. First, let me recognize that these proposals represent the culmination of several years' work by the PCAOB that has taken place in the context of global reexamination of the auditor's reporting model with the objective of making the auditor's report more informative. I commend the PCAOB for this effort and applaud the continued outreach, including this public meeting, to seek feedback from all stakeholders. As the board has noted, the auditor's current pass-fail model is still highly valued. Therefore, it's extremely important for the board to consider the feedback from all stakeholders to look for ways the audit report and the role of the auditor can continue to evolve to better meet the needs of stakeholders today and minimize unintended consequences. Speaking on behalf of PwC, we support the changes to the auditor's report, including reporting with respect to other information that will be responsive to the feedback while maintaining or improving audit quality, avoiding the auditor becoming the original source of information about the company. I'll talk more about that in a second. Ensuring the benefits exceed the cost. And I believe these proposals represent a really strong step in how we can enhance the current auditor's reporting model. In addition, we're challenging ourselves to continuously explore ways to enhance the role of the auditor beyond what the profession does today in order to address the evolving needs and complexity of the global capital markets. While we believe there is much in the board's proposals that has merit, we also have concerns that some of the fundamental changes included in the proposals pose challenges. Today I'll describe certain of these challenges and then offer suggestions that we believe will still achieve the intended outcomes of the proposals while mitigating unintended consequences. I'll briefly touch on critical audit matters and then focus my comments on other information. With respect to critical audit matters, we understand and support including critical audit matters in the audit report as a way of making it more valuable to investors. However, we believe it should be limited to or focused on matters that were material to the financial statements that resulted in the most significant interaction with the audit committee. We believe these changes and others that we suggest in our comment letter would add meaningful information to the audit report while not placing the auditor in the position of being the original source of information about the company. It will also minimize the potential that including critical audit matters in the audit report will chill the dialogue between auditors and management something which could have an adverse effect on quality. Now, in listening to the discussion yesterday, which I thought was outstanding, a couple of comments that at least with respect to PwC's position on CAM, I think is worth some clarification. There was the notion that if the auditor is not the original source of information about the company, then isn't the auditor just repeating what's in the financial statements? And at least our view of things is no. That an example of what we would be concerned about is potentially a litigation matter that the auditor discusses with the audit committee. The culmination of that discussion was that no disclosure was required because it was remote. Well, theoretically, under the proposal, there may be some pressure to record that or report it as a critical matter, thereby driving disclosure that management is not required to make through the audit report, and we would be against that. However, that does not mean that the auditor can and shouldn't say more about the matters that they are reporting on as CAM, and specifically the issues that, in the auditor's judgment, drove the CAM disclosure. Whether it's the materiality of the matter, the judgment involved in coming up with the matter, the susceptibility to change, and talking about the audit response to why something was a CAM. And you won't find that information in the financial statements, but that's information about the audit, and I think that that can be valuable to investors. The other point I want to raise from the discussion yesterday was this notion of 91%, and that 91% of investors don't read the auditor's report as it exists today. My own view is that's a very misleading statistic. We do substantial outreach to the investor community at PwC through our Investor Institute run by Kayla Gillen. And the feedback we get from investors is they may not read the reports word for word. It's a standard report. I wouldn't expect most to do that every time. But they look at every report. They look at every single one for who the auditor is and was there something in the report that went beyond the standard. So I go back to what Chairman Doty said when he opened up the meeting yesterday. The pass-fail report has value. I would say it has quite a bit of value. What we're talking about today is how do we enhance that value and make a good product better. So back to other information. We support the board's intent to enhance the existing standard by requiring communication about the nature of the auditor's responsibility for other information in the report. However, we believe the proposed standard as drafted could potentially increase rather than decrease the expectation gap and risk increased execution or inconsistent execution by the use of language that's ambiguous and susceptible to varying interpretation. In addition, we believe the proposed other information standard will result in a significant increase in audit effort, particularly with respect to information not directly related to the audited financial statements, with a corresponding significant increase in cost that, in our view, could exceed the value or the benefits. To be clear, we are not opposed to enhancing the performance standard beyond what it is today if there's a market demand for such an enhancement. However, enhancing the performance standard will, by definition, require additional work, which will increase cost. It's our understanding that the intent of the board with this standard was to have the auditor report on the information generally based on the level of work performed under existing practice. If that's the objective, we believe certain changes should be made to the proposed standard, which I'll describe. As an example of language that's ambiguous and susceptible to varying interpretations is the use of the term evaluate as the performance standard. We believe this term is more commonly associated with the auditor's responsibility in an audit to determine whether the evidence obtained is sufficient and appropriate to support the opinion to be expressed in the auditor's report. We recommend replacing the proposed performance standard of read and evaluate with one that is more likely to result in consistent execution and more efficient in terms of the value provided for the effort involved. Specifically, we believe the proposed other information standard should include an overall requirement that the auditor read all other information regardless of whether that other information is directly related to the audited financial statements. The auditor would then perform a prescriptive set of procedures similar to comfort letter procedures with respect to material other information directly related to the financial statements. Finally, we recommend the language in the auditor report explicitly describe the limited procedures the auditor performed as opposed to a conclusion, thereby decreasing the expectation gap and eliminating the practical challenges associated with a conclusion. If the stakeholders would find value and demand exists for the auditor to perform procedures on non-financial information, then perhaps a separate attestation engagement with separate reporting on other information could be considered. Good discussion yesterday about potentially an attestation standard with respect to MD&A or elements of MD&A. We would support that. So in closing, I'd like to again thank you for the opportunity to provide the feedback on the proposals. The recommendations I've outlined today and the others provided in our comment letter are intended for the proposals to meet their intended objectives while minimizing unintended consequences. These proposals represent a strong step in how we can enhance the current auditor's reporting model, and I look forward to continuing the dialogue as we evaluate how we can further enhance the role of the auditor in the capital markets beyond what we do today. Thank you, Mr. Chairman.
The panel has given us a lot to chew on. Mr. Harris?
Well, I think I agree with both Pete and Mike with respect to the term evaluation and the need to develop a more common understanding of what the word evaluate means. I'm not quite clear, Mike, in terms of what you're recommending other than describe the procedures that were followed. And Mike, you're a lawyer, so between the three of you.
I didn't come here to be insulted.
It wasn't meant as an insult. Especially given your commentary, which is much appreciated. But how would each of you, what term would you use other than evaluate and other than describing the procedures that would presumably go to the word evaluate? Is there a term of art that you would prefer?
Steve, I guess as I mentioned in my comments, I think the most plain way to communicate is just to share, in plain English, what we did. And just to give you a flavor of what that would be, typically, as you're probably aware, in comfort letter situations, when companies are raising capital and the underwriters are doing due diligence, typically what the auditor does with information in MD&A, for example, where there's comparisons around revenue or other financial metrics, is the auditor would recalculate the numbers that are shown in MD&A. They would compare it to information that's included in the audited financial statements to the extent that exists. To the extent that doesn't exist, you tie things back to original books and records, which are subject to a company's system of internal accounting control. And so our view is the best way not to have an expectation gap, because I'm not sure there is a perfect term that would capture in a word or two what we do, is just let's lay it out. Let's explain that if information is directly related to the financial statement and it's in there and it's potentially material, we do these, prescriptive, this is what we do. And with respect to the other information, we do what we do today. We read it for consistency and look for material inconsistencies in the financial statements.
And then, Mr. Young, I think that you quoted Chair White in terms of the concern about information overload, and you talked very eloquently about being concise and understandable. So I think that I don't disagree with where Mike is coming from in terms of describing evaluation, but you could get into some pretty significant information overload just in the description. So how would you concisely deal with the term evaluate?
I wish I had a good answer to that. And appearances notwithstanding, I really would like to be helpful. Let me tell you the challenge as I see it. And that is, I agree with the problem with the word evaluate. The challenge is not so much the verb. The challenge is the broader concept of the auditor speaking to the truthfulness of the information. Because users of the information are going to be inclined to boil it down very quickly. And if they see the auditor speaking to the subject of the truthfulness of the information, they're not going to think about whether the word is evaluate or examine or inquire into or review. They are going to say to themselves, the auditor spoke to the truthfulness of the information. The information, as we now know, turned out to be false. And therefore, it sounds like the auditor didn't do its job. And to illustrate, let me describe a newspaper story that we have all seen many times, and that is, the newspaper story says there was a fraud at XYZ company. The auditor failed to detect the fraud. Where was the auditor? How many times have we seen the newspaper story go on to say, however, under the applicable auditing standards, this fraud was conducted in such a way that the auditor would not be expected to detect it? I'm still waiting for that story after more than 30 years. The challenge, as I see it, evaluate is a troublesome concept and a troublesome word. I agree with that. And I wish I could say that that problem can be mitigated by choosing a different word, but I think the problem is more deep-rooted than that.
Mr. Ferguson.
Yeah, I want to focus for a minute to see if I understand what was said correctly, and I want to focus particularly on the statements that Jeremy made and Mike Young, which seem to me in many ways polar opposites, and to present us with a binary choice here. As I heard you, Jeremy, you said that indications, or that statements by management, things like key performance indicators, non-GAAP measures, are not subject to audit and are area, because they're not looked at, are potential areas for fraud or for manipulation or for management to tell a story that is not necessarily reflected in the audited financial statements. You, Mike, on the other hand, seem to say that if we have the auditors start looking at these things, we will inevitably inhibit their use in such a way that, and that they are effectively the only really clear communication management makes, that the audited financial statements are increasingly not relied on by investors, and that we will actually make disclosures by management less useful. Those seem to me to pose a binary choice. You know, we're damned if we do and we're damned if we don't, under your two arguments together. Are they reconcilable? Am I mishearing?
Lou, I actually think that they are. And let me try to reconcile them, because, first of all, I'm a big fan of Jeremy and his firm, and I've got Howard Schillett's book on my shelves, and he and I are in the same business, which are investigating problems. I think they are reconcilable, and let me explain how. One of the things that Jeremy told us was that these different ways of looking at things can be helpful, and that's true. They can be helpful. Another thing is, we did not hear from Jeremy that the information is not truthful. We just heard that it's not the best way of looking at it, and I give a lot of credit to the sophistication of investors. I mean, I think Jeremy's main point was that the information is being sliced and diced in a way that, while it's truthful, creates an impression that you shouldn't have if you look at different ways. Also, the information that Jeremy's talking about, I don't think would get included in other information. I mean, the 10K isn't going to have that kind of non-GAAP information, so the other information proposal wouldn't really reach it. You would have to even go further than other information. If in fact, well, let me stop there. So I'm not hearing from Jeremy that this is misstated stuff. It's just looking at it in different ways, some of which is helpful, some of which may be less helpful. That's not what I'm really speaking to. I'm really speaking to the concern that management will strip out sort of the dot connecting subjective information because of concern about auditor recalcitrance. Is that helpful?
Yes, I mean, that is somewhat. I'd like to hear from Jeremy, too, though.
Yeah, and what's most interesting to me, and I understand right now the scope of the proposal is very broad, all other information, but my comments are more focused on all detail and disclosures related to communicating the financial performance or financial status of the company. So anything like market share or subjective comments like that, I'm less concerned about. It's more, here is our adjusted earnings, or here is our non-GAAP revenue.
Statements that are based on the financials.
Based on the financials, derived from a proxy for.
Which is different from the connecting the dots information, or can be different.
Yeah, but how would the auditor police that? I mean, if it's true and if it's consistent with the financial statements, is the auditor going to say, we don't think that's the best way of looking at it?
Well, I do also want to say, most of the time it is true. It's a way to communicate it. But many of the frauds and many of the, fraud with a lowercase f, if you will, are rooted in these misstatements that are subjectively altered. So I don't want to say that there are no misstatements in there, but this is the area rife for discretion that I think right now it's beyond the auditor's reach, and stepping into that area will it's not just a matter of policing the metric, it's a matter of changing the overall behaviors. Maybe auditors or maybe companies would not use some less relevant or manipulative metrics.
Mr. Hanson.
Got a question I'm going to direct towards Pete, but want everybody to weigh in. And overall, the feedback we've collectively heard from you and others that the use of the word evaluate is problematic. The scope of what gets included is problematic. That's what I want to dig a little bit deeper on. And also the fact that it's a game changer that the auditors actually report on the conclusions from that. And I'm kind of surprised that none of you touched on that one. So I want overall reaction to the actual reporting of we did this stuff, evaluate, or whatever the procedures are, and didn't find anything. But on the scope, and Pete, you teed up that this is somewhat similar to what's accomplished in a comfort letter. And my experience with comfort letters, that Underwriters Council starts with they want every single number, including the page numbers, some sort of comfort given on it in this 200-page prospectus. And by the time you're all said and done, there's a lot on the cutting room floor that there's no comfort given on, so that whatever's disclosed falls on the floor. And the hierarchy of what Underwriters Council usually wants is, gee, if you can trace it directly to the financial statements, that's the best. The second best is to the general ledger. Third best is to a schedule which reconciles to the general ledger. And then fourth is to a management-prepared schedule that doesn't tie to anything, which those sometimes fall on the cutting room floor. But the exercise of doing the comfort letter is very precise in that the exact number that you are giving comfort on is circled with the exact procedure identified as to what was done. And one of my concerns is an investor will never know what comfort was given on any given number within the other information because it's not distinguished. In some numbers, there will be some comfort given because it reconciles the financial statements tied to the general ledger, and others, there's not a darn thing you can do about that number because the auditor doesn't have that information. And what we're doing in this proposal would not impose an obligation to go find the support for every number. So, Pete, any ideas about how we could better identify to investors to make it more useful for them, and maybe your reaction to how your team of analyst investors would think about this with unknown, we don't know what the auditor actually did and whether they did anything to the numbers we find most important. Is that even helpful if it's well, I don't know what the auditors did, so I can't really take any comfort at all in it?
That's compelling testimony. Does Michael Gallagher agree that you're tending toward a comfort letter approach to this?
Yeah, I believe, I think that we have to be careful not to have the perfect be the enemy of the improvement. And I think regardless of what standard you put out there, whether it's Evaluate or some other standard, because of the different nature of the information that's included in other information, you're going to have varying degrees of comfort, if you will, for lack of a better word, in terms of what the auditor did and what the auditor was able to do. Now, I would hope, whether it's through technology or some way, that the numbers that can be traced back, to a system, something that ties to the general ledger or something that is covered by the system of internal control, perhaps that can be identified in some way, to give that reader better precision in terms of, at least some sense of what was done relative to that. But in the meantime, I think some of it will be intuitive. I would say maybe pick your percentage depending on the investor. Clearly, if it's a revenue number or something that's directly related to the financial statements, it'll be quite clear based on the articulation of the report, well, that was something that was tied to the financial statements or ultimately something that came from the internal control system. But in the spirit of making improvements and not having it be perfect before we make the improvement is in the spirit of where we were going with our suggestion.
It's a great question. And I think, first of all, by referencing the comfort letter process, I think that's a somewhat imperfect process for the reasons you mentioned. It's all about the investment banks throwing the risk football back and forth between the accounting firms. And so the more they can get the accounting firms associated with every number, including ridiculous things, the page number thing isn't too far off. Anything a monkey could do, and they could have their own staff, but they want to have the auditor on the hook. So I don't think slavishly following the comfort letter approach is probably going to be workable here. I think something that's closer to read and consider, although I'm sure the lawyers in the room and at the table will say, well, that's no less specific than evaluate, and I agree it's not. But it is something that's exactly what the auditors do today, and I think we have to put some of the burden on this into how the standard is drafted itself. What does it mean when they say, if we stuck with evaluate, which I hope we don't, but if we did, it's got to be very clear what that means. If we say read and consider, what does that mean? Right now, I think everyone in the accounting profession understands very clearly that means A, read it, B, consider whether it's inconsistent with anything that's in the financial statements you've audited, and C, make sure that if it comes out of the books and records, you've got even more certainty about it. So I think there's a great understanding of the profession. I don't think, fairly stated, in a current standard audit opinion, if we were subjecting that to the same level of scrutiny we're subjecting these words to, we'd have the same issues with fairly stated. But people have gotten used to that over many, many decades of reporting and what the standard says. I also think we're in completely unbroken ground when over many, many decades, we're talking about a two-paragraph opinion that sometimes some of the firms reverse the paragraphs or they combine the paragraphs, but they pretty much all say the same thing. And that's given investors and users a lot of comfort because they don't have to read a report and guess, well, what's the auditor telling me? If it's pass-fail, I know if they passed it, they've got a good understanding of what was done. So I think a bunch of what's in scope comes from what are you going to ask the auditors to say, and then, again, what should be in scope. I think non-GAAP financial measures, by and large, virtually every number, I know certainly the ones that Legg Mason reports, of which we've got primarily 3, and frankly, I talk to investors that probably 40% of my life is spent either on earnings calls or in investor sessions with both sell-side analysts or buy-side investors. And Legg Mason is a buy-side, so our mutual funds are out investing in things every day, but they're relying on sell-side analysts who mostly work for the Wall Street firms in terms of their diagnosis of our financials. They're not only relying on that, but they heavily rely on it. And frankly, 80% of the questions that I get, and I get all the numbers questions, my CEO gets all the fun ones to talk about strategy, et cetera. 80% of those questions are about the non-GAAP measures because GAAP, unfortunately, forces us to do some things in our financials that the analysts look and say, that's not relevant. I'll give you one example, and then I'll pass the microphone on, but net revenues in our business. There's a lot of tension around wanting to make sure, in accounting parlance, we're reporting everything that is coming in, and then everything that's flowing out as an expense, and what's left for the shareholders. But in our business, we have a huge amount of marketing costs that are referred to as 12B1 fees that are highly regulated part of the mutual fund business, and 100% of those fees are pass-throughs to the distribution partners that we have. So no one looks at that as revenue that comes to Legg Mason because why in the world would you be in a business where you have 100% of your revenues going out as expense? So the analysts want to understand in terms of are we running the business efficiently, what is the net revenue that's actually coming to you that you're managing, and what's the margin you have off of that? So again, very few of the questions that I get go to the GAAP numbers, they go more to the non-GAAP.
Ms. Frenzel.
Thanks for being here today. Assuming we get the verb right here, evaluate, consider, read, or maybe we need more than one, sort of verb to apply to different categories of information. I'd be curious to hear your thoughts on that. But what are the categories of information that you think would be most important to have some kind of explicit auditor involvement and conclusion on? Right now we've got a very broad, other information. Are there certain categories where you would envision that we'd get most value from auditor involvement, and what level of auditor involvement would that be? And it's a question for all of the panelists who'd like to respond. Start with Jeremy.
Yeah, I think, in my mind, it's a no-brainer for there to be auditor involvement on anything used to communicate financial performance, be it a number, be it a qualitative disclosure about why revenue grew 10% this year. I would say that area is the most important area. Everything else would be below it.
I'm a listener on that one, so I'm going to defer.
Yeah, I like the discussion that was held yesterday where we discussed and we supported the CAQ proposal of reporting the auditor involvement with critical accounting estimates because those are the things that, if they're done right, are really the most important things that drive financial performance or where financial performance could be affected most significantly. And I think there is a real opportunity to up the game in terms of how well they are written. Right now, there is not auditor involvement beyond the read and consider. I think if the auditor were to attest to that, I think the quality of compliance with SEC rules and the clarity with which it was written, I think would only improve. So supportive there. And as I said, I do agree with Jeremy. Things that are most significant and directly associated with the financial statements that really drive how a company is evaluated is where the auditor involvement should be greatest.
Yeah, again, it's a difficult issue. I think investors probably today assume anything that has a dollar sign on it, or even if it's a number, that the auditors have done something with it. Frankly, I think it's difficult for the audit profession to do much with things that don't come directly from the books and records, and things that are subject to the internal control system, and a lot of thought and theory that's been put into internal controls by a number of bodies, including COSO. But I think confining it to things that are within the expertise of the auditor, mostly financial information, financial numbers, the things that so often, and I've been in these tense meetings with underwriters that they want auditors to comfort, and the same kind of things that I think Jeremy's talking about here. I agree they're important numbers. So things like square footage. So a firm that owns office buildings or regional malls, et cetera, has square footage as a key, not so much performance indicator, but certainly a key statistic in their financial reporting. Yet there's incredible amount of subjectivity as how you measure square footage. So I used to do some real estate work in a prior life, and in New York City, we always talked about the gross leasable area was how far you could throw your boss out the window, and then you've got to measure that distance onto the sidewalk. And this was all a game of the real estate brokers and the owners and the tenants deciding how much they're going to pay in rent. And then what's leasable area? Do we count the restrooms? Do we count the elevator shafts, et cetera? Things that accountants clearly aren't capable of assessing. Second one, proven reserves. So in the resource, oil and gas, minerals business, et cetera, incredibly complex. Not something I can tell you. I'm a CPA. I spent many years both in school studying for the exam, in practice, and in no way, shape. I know what a proven reserve should be, but am I engineeringly capable of going out and verifying it? Absolutely not. And then last but not least, in the valuation space, and there was a time in my prior life at Deloitte where I ran the valuation practice for the firm, not because I was an MAI and knew really the first thing about the science of valuation, but the firm needed somebody back when FAS 141 and 142 came out to connect the valuation folks to the auditing folks. And it's a very different, again, amount of rocket science that goes into valuing things, whether it's hard assets or financial instruments. So I know I haven't given you a clear answer to that. This is why I'm suggesting that we have to be very careful at constructing this thing and making sure that we don't cause more confusion by people assuming once the auditors started reporting on information, if it's not clear exactly what they've done, on what numbers, we create some difficulty. So the last point, in going back to this, we're breaking new ground on the reporting. Everybody's taking comfort in having this one-page, two-paragraph opinion. I mean, we may be in a land where you need an appendix to the opinion that describes exactly what's done. You don't want to torture everybody. You have to read that to get to the substance, but it might help with the litigation protection. And for the ones who really want to go deep on this, they'll have the information as an appendix to the report.
Brian Croton.
I think, Pete, you just started to actually answer the question I was going to ask, but I wanted to come back to the evidence point again. Obviously, again, for the financial statement audit, there'll be a range of evidence the auditor gathers and has in its files, and some information will be covered, would be covered under today's model and under the proposed standard, and for other information, there'll be a range of relevance relative to the information in the auditor's file. And To the extent that we're talking about a report that is a paragraph or two versus describing for each specific element of the other information what was done, my question was really, is it more risky or more helpful to have that kind of report? And I'd be interested in others' thoughts on that. I think, Peter, you just started to answer that question. Be interested in what others think of that.
Forgive me, I don't understand the question.
So in some cases, the auditor may not have any information from the financial statement audit in the file. In other cases, the information the auditor has may be relevant to some degree or may be completely relevant to the other information that's being looked at, but yet the report we're talking about wouldn't necessarily identify what was done for each element. And I guess my question is that kind of report that generally describes what the auditor has done relative to the other information, the procedures performed, helpful? Or is that likely to be more confusing without what Peter was just describing, sort of the tick mark legend, if you will, of what was done for every element?
Right. Here's the challenge. And that is, let's say we want to take, I'll call it a comfort letter approach, because that really crystallizes it. You got a number, you circle it, the auditor looks at the number, very little ambiguity there. The challenge is coming to that level of clarity, that level of crispness, that sort of line of demarcation when you're talking about other information more generally. Now, sure, if we could have the auditor circle numbers, well, yeah, okay, that would take care of it. But in a sense, almost anything you say about the business, it at some level ties to something in the financial statements. And let me give you an example which makes it perhaps a little bit more concrete. And that is, risk management is a big thing right now, disclosure about risk management. And let's say that the company says, and speaking operational, we believe we have effective risk management. Well, the auditor knows that the company has FAS 157 level 3 assets. And let's say, sure enough, the value of those assets goes down. And then the contention is, auditor, how could you have allowed management to say they have effective risk management when you knew they had FAS 157 level 3 assets? And look what's happened. The value has gone down. That's not effective risk management. How did you let them say that? Now, that's an example. You don't think of an operational statement about effective risk management as really tying to the financial information, but those dots are not difficult to connect. How realistic is that hypothetical? Not only is it pretty realistic, it's not even very creative.
Mr. Baumann.
What do you do in that situation with respect to level 3 assets?
Steve, let's hold it. Let's let Marty pursue the question, then we'll get back. You'll get another round.
Thanks. You've all made a great contribution to this important topic, and I really appreciate Mike's comment about don't let the perfect be the enemy of the good here. Jay asked a really good question when he talked about investors really don't know which level of assurance was given on different numbers because the auditor knows more or less about different numbers in the other information, and that's a good point. But still, can't we still improve auditor reporting without getting perfect in this regard? I'd be interested in Mike and Jeremy's reaction to a comment that was made by Pete in his remarks that we are the fastest growing company in this industry. Is something that he said auditors cannot report on that type of information. Now, as part of the risk assessment standards, auditors are required to gain an understanding of the company and its environment, which encompasses industry factors, including the competitive environment. So auditors have to understand the company and its environment as part of the risk assessment standards. So if the auditor is doing that and is reading company reports about its growth, its strategy, also minutes of the board of directors, and is aware of the fact that they believe that they have some problems in growth and that they have competitors that are growing faster than them and have better products than they do, and the auditor reads that statement that says, we are the fastest growing company in the industry, but the auditor knows that that's not what is reflected in management's own records in the board meetings that they attend or audit committee meetings. Is that not the type of information where the auditor could and should say to management, we think you have a material misstatement of fact here that we think has to be corrected. So, and isn't that the kind of information that otherwise could be very market-moving in other information that might be at the heart of what we're trying to get at here?
Yeah, I think that would be a material, if the auditor saw that as a material misstatement of fact, that would be a great area for discussion and something that the auditor could speak about and communicate with management, absolutely. I recognize the subjectivity of that particular statement and what are you using to make that judgment, what growth in what measure, and you can pick any measure and say we're the fastest growing company. However, I do think that would be a helpful area. Less important to me than actual financial reporting numbers, but helpful.
So, Marty, the way I think the auditor would approach it today is ask management, okay, you're making this statement. What is it based on? You know, recognizing that's a very ambiguous statement. There's so many ways you could measure, you know, fastest growing. So very ambiguous, and you'd want to get behind it in terms of what is your basis for making that claim. And if there wasn't a basis for making that claim, I think the auditor would likely raise it and say, hey, this is problematic. But it would be very difficult for the auditor to report on that because of the subjectivity of it, and there's probably some metric that they can find, given the ambiguity of the measure, that they might be able to support the claim. Whether you think that measure was a reasonable measure would be another matter. So that's the caution we would have as auditors in terms of reporting on information that's fundamentally not objective, it's subjective and potentially, you know, ambiguous.
I think, Marty, I recognize as well that that's, you know, an important area for investors to have a feel for, but a question of whether the auditor is the right place to get the information, or a standard that we can craft that everyone would agree objectively. First of all, how do you define industry? And so there's many subsets and levels of SIC codes we could go through as to, is it, you know, a very finite example, like Mason, are we a financial services company, in which case you're going to compare us to insurance companies, banks, broker-dealers, et cetera, or are we an asset management company, and within that, are we an active asset manager versus passive, like a Vanguard, et cetera. And then getting into the unit of measure, is it, or what is it fastest growing? Is it units of production? Right now, you know, most tech companies that are being sold for billions of dollars have, you know, fast-growing stuff, and they're not making any money. So is it, you know, growth in profitability, growth in units of sales, growth in revenues, I think is where the challenge is. But like Mike, in my prior life, if I had a management that was consistently, you know it when you see it, and if they're consistently misstating things like that, those are the kind of clients you say, should we be associated with?
And Marty, or at a minimum, if they're making that kind of statement and you know it's factually wrong because in their minutes of the board meeting they've asserted, you know, we're the third fastest growing in our industry in every single category, you want them to, when you read and whatever the verb is, evaluate or consider whatever, say, maybe that's something I've just read that I think either management has to correct, or my report would say, we did read this and we found something to be materially inconsistent with our knowledge of the company and or material misstatement of fact.
Steve Harris?
Yeah, go ahead, Steve.
The question on level 3, what's the responsibility and role of the auditor to report on, in essence, impossible to value assets?
Well, I mean, I would think it is to come to a judgment as to whether management's judgment in trying to value the assets is fairly presented as of the date of the valuation. You know, I would not view the auditor as having a, now I'm talking about auditing standards. Please correct me where I go astray, but I would not view the auditor as having a responsibility for you know, thinking what the value is going to be next month. It's what is the value under level 3 as of the date of the information.
But there is no value. I mean, level 3 is, from my
there's a value. It's just hard to figure out.
There's such a range. I mean, from everything I gather, it's such a range that it's virtually impossible to value. So in essence, what you do is, to what extent is the auditor responsible for reporting the difficulty of valuing the level 3 asset,
well,
if at all?
Yeah, that actually is a very good point, because it takes us to what Mike Gallagher was talking about earlier about critical audit matters. And that's one, if I may leave other information just for a moment, I mean, that's actually something that would be useful for investors to see that this is a challenging number. You know, we got a FAS 157 level 3. But you have to come to a value. I mean, the FASB doesn't say, gee, it's tough to value, so just leave it blank. Louis?
Yeah, Alan Beller talked about this yesterday, and as I heard him, what he said, he had two concerns about it. One was the question that there did not appear to be any materiality standard in terms of what the auditor did. And number two, you didn't really know what the auditor had done beyond evaluate this large body of other information. Would it help, for example, if, assuming we cure the problem of evaluate and come up with a definition of what the auditor was, that is clear and understandable, people know what it means, that beyond that the auditor has to say, and in addition, we performed procedures with respect to the following areas. So the reader knows more specifically in this body of other information what areas the auditor thought were worthy of attention enough to do work on. Does that help?
So, Lou, I'd break it down between other information and CAM. And I don't recall yesterday whether Alan's comments were focused on potentially articulating procedures with respect to critical audit matters. That I would be less enthusiastic about a litany of procedures that was performed that may call into question whether you have a problem with that number or not, as opposed to other information where, again, if the purpose of the board was to capture what practice does today with respect to other information, and we do things that go beyond what we're required to do in order to manage our risk. So we're required to read and consider. Do we do more than that? Sure. We tie numbers out all the time, whether it's in connection with a comfort letter or just to get the 10K done. Every number in MD&A, that's the key numbers for sure, are tied out. So I think articulating procedures and what we do, just being transparent about what we do today, recognizing the imperfections that from Jay's comment, which we recognize. And I think Brian's question is exactly the right one. In terms of the consumer, would they find it to be more confusing or would they find it to be helpful? I think that would be a great thing to test in a field test.
Are you saying that you do think that would be helpful to?
I think in the context of other information,
yes,
not CAM.
That's what I'm asking. I'm not asking about CAMs. I'm asking about other information.
I do, but I would keep it limited to a few categories, not an endless articulation of individual procedures.
Jay?
Question mostly directed at Jeremy around the non-GAAP financial information. It seems to me that one of the problems is there are no standards around how you present any particular non-GAAP measure. And I know that we can't solve that problem, the PCAOB, and I'm looking at Mr. Croker, and I'm guessing that he would say, gee, we're having enough problems with disclosures on GAAP matters, much less taking on non-GAAP measures. And Brian's colleagues in Corp Fin are the ones that tend to do some policing of the non-GAAP measures, but it seems like there is a fundamental problem of there are no definitions behind it, nothing uniform, even with something as on a simpler end of the scale, same-store sales, that there are many ways to compute that. But without solving that problem, which I don't know if is even solvable, I think we're always going to have the problem of people saying whatever they want to say with whatever caveats beyond it, and there will always be a schedule that describes how the number was computed. But you made I'm trying to figure out what my question is here, because you have suggestions about getting at the core of that problem of it's a wild, wild west relative to non-GAAP measures, or is it your message really that auditors paying more attention to that may curb just the use of some non-GAAP measures at all?
It's a great topic, and I think Pete illustrated it really well when he said that 80% of his investment community asks him more about the non-GAAP metrics than the GAAP metrics. And I'm not an advocate of banning non-GAAP metrics or turning them all into GAAP or telling companies that you can't report this information, because I agree it would curb information flow. And I recognize that this is a fundamental problem that the system has, that it could foster a Wild West situation. But I think there are absolutely steps that could be taken, particularly from the auditor's perspective. Some easy ones include, we all know for every company what are their most important investor communication metrics. Pete just said at his company there were 3 non-GAAP metrics. that they use. You go to open any earnings release and you look in bold on page 1, and you can see right there what they're communicating to investors. For those metrics, at minimum, to not have any robust quality check or auditor scrutiny on them, I think is a problem that could be fixed with some procedures. I don't want to suggest everything and anything needs to come under the umbrella, but there is a way to pick off the most important investor communication metrics.
And just a commentary on that, which we've heard some feedback in different settings that auditor involvement with press releases, and actually Mike Cook, one of our standing advisor group members, talks a lot about the need for auditors to get on the train earlier than at the tail end when the audit report is issued. But that, and in most companies, the auditors do have some involvement with press release, but definitionally, since most major companies issue press releases long before the audit report is ready to be signed, it's an imperfect exercise, and the auditor's never going to be able to sign off because they're not done with their audit yet. So that is a real challenge.
Now, I recognize that. I think many of these metrics do find their way to the MD&A, and just this overall scrutiny over what the most important metrics are will influence what metrics are used. And just to acknowledge, the audited financial reports are not the primary communication tool with investors. They're not secondary. They're not tertiary. Above that are the earnings releases, the conference calls, the PowerPoint presentations, the one-on-ones. This is how companies communicate with their investors. And the audited financial statements are well below that. So I think, and I know it speaks to a grander change in the system, but I think some kind of involvement with the key measures reported in those other communication tools only makes sense from an auditor's perspective. That's where investor protection would be best served.
If I could just add to that, I think that I agree with Jeremy, and I would certainly be supportive if the demand exists on the part of the stakeholders, investors, and others to have auditor involvement in press releases and others. But I would also say that this notion that the audit is all the way at the back end, which from a time perspective it is, but I think when a press release comes out, there's the knowledge that an audit's being done, and God help the company that has numbers that are different in the audited financial statements from their press release. Now, you do have that. Sometimes you have a subsequent event which was beyond their control, and I think the market generally understands that. But if a company consistently, like more than once, has an issue where there's a disconnect between those audited financial statements which come later, and those numbers are different than that press release, they're going to pay a pretty heavy price.
Jeanette?
I want to talk a little bit about the potential impact of whatever we do. Let's assume we can get it exactly right. The impact on perhaps increasing the expectations gap, because to me that seems to be another factor that we need to worry about. So if we define auditors' involvement and we define the scope of auditors' involvement, yet you do have some qualitative connecting of the dots and presentation matters that could potentially be misleading, even though the auditor has managed to get comfortable with the various numbers. What do you all see as potential risk here in terms of increasing expectation gap, and what advice would you give for us to consider that? Start with Jeremy. And I think, Michael, you touched on a lot of that.
I think the expectation gap it's very large right now. I'm not too worried about increasing it. A question I get very frequently from investors when I point out some sort of misrepresentation is, why aren't the auditors looking at this? Whether it's in the press release, whether it's in the MD&A. I would say if you surveyed investors, the vast majority would think that the MD&A is audited. Maybe not the press release, but I think the expectation gap is so wide, I wouldn't fear implementing something just because it might increase.
I think that in everyday language, this will start to be referred to as auditing MD&A or auditing the 10K. And the distance between that articulation and the reality will be the expectation gap.
And I actually agree with both what Jeremy and Mike have said here, and I think there is a huge expectation gap today. I do think that investors, by and large, believe that if auditors have signed off on audited financial statements included in some other public filing or in a public filing, that virtually all of the other information, particularly if it's a number, and if it's got a dollar sign, even more, that the auditors have been involved with that. And even the ones who have a better or more sophisticated knowledge, I think, assume that, okay, I realize the auditor may not have subjected it to the same level of audit procedures, but it's a higher level than what auditors are capable of doing. So I think this is a great opportunity to tighten that expectation gap, but depending on how we ultimately articulate the proposal, it does have the risk of creating more confusion.
I agree with Pete's comments, and I go back to Brian's question. I mean, the true test here is if we can experiment, whether it's finding the perfect word or articulating the procedures and get a reaction from those that use the financial statements and look at the other information and get a reaction. Is this helpful? Is this widening the expectation gap, or is it closing it?
I'm concerned, listening to Michael and to some extent the rest of the panel, with the notion that we have now auditors, as a matter of practice, looking at other information. The concern that if the issuer knows they're going to have to say something where they find inconsistency, this will result in management leaning toward cooking the books. They will lean toward withholding information. They will lean toward trying to make it to neutralize the comment. It seems to me that they do that at their peril, and the suggestion is that what comes out of the suggestion is that the involvement, some involvement, as Jeremy is suggesting, of the auditor and the audit process in other information and addressing inconsistencies should produce management conduct that is better. I understand the liability issue, but is the panel comfortable with the notion that we will not empower the auditor, we will not, by virtue of directing the auditor to form judgments of some kind? We've decided that what comes out of this panel discussion is there's a lack of uncertainty about evaluate, but requiring the auditor to form some judgment and communicate some judgment. Is that consistent with best corporate practice and best disclosure? Do you believe that in fact leads us away from boilerplate? So are you willing to say we're going to abandon the attempt to have the auditor perform some judgmental review and then, having done it, communicate that? Is that where you are? No involvement.
Look, I know you guys have put a lot of work into this, but I'm afraid that's where I am. And let me respond to Warren Buffett. In his most recent shareholder letter, says something about a write-down, but the number is economically meaningless. If an auditor were reporting on that statement would not be in there. And I remember an earlier shareholder letter, but I do other things in life besides read his shareholder letters. But an earlier shareholder letter, I think we talked about a reserve, and he said the one thing we know about that number is it's wrong. If an auditor had responsibility for reporting that sentence, it wouldn't be in there. And my concern, let me say it this way, the lawyers will take over. The lawyers will go over the disclosure and they will look at the risk and they will say, fastest growing, maybe it's right, but there's evidence to the contrary, get that statement out of there. Economically meaningless, get that statement out of there. And the thing, 10-Ks have so little life now. Maybe an argument is they're so unbearable now you can't make it any worse. But, hope springs eternal. And my concern is, bluntly, the lawyers will take over.
Chairman Doty, as I said in my comments, I generally favor the standard. And I think because, going back to Jeanette's question, I think there's more risk and harm today in terms of a lack of understanding of what auditors are involved with in the other information, that we can close that expectation gap. And I think to obviate the issue that Mike so wisely raises, you don't want to limit, what Warren Buffett could write, but those kind of subjective things are not really the purview of the audit firms, and we shouldn't be forcing the audit firms to get involved in that stuff. Again, I think it's much more about reporting on what they already do to make it clear to investors where the auditor's been involved in other information. As Mike Gallagher said before, and again from my experience of 25 years at Deloitte, we're involved with a lot of the information, and we just have to come up with an appropriate way for them to report on what involvement they have, what the information is they're involved in, and the level and scope of what they've done.
Well, there's a real dichotomy that emerges because Jeremy began with a very profound statement that he says he has an understanding in his career of how information is read and used, consumed. The whole panel, I think, fits that description. You all have, through your careers, a heightened understanding of how information is read and consumed. And I take it that along with Mike Gallagher's written materials, I thought there was not the same reluctance or the same concern about the critical audit matters, the CAMs, that in fact, in your view, some of the arguments made that evidence concerned with involvement in other information would in fact suggest that you think there is not a risk in having CAMs in the audit report, that it's a different breed of cat. I know it's not your panel subject. And there are issues of naming the engagement partner and the tenure of the firms that were discussed yesterday and that are coming out of the European model and that we're considering. I would like to know the panel's views, as sua sponte as they are, on whether, in fact, we should proceed with CAMs, engagement partners, tenure. Are these matters that are a different issue than the ambiguities and the dangers of other information?
May I speak first to that?
Please,
and let me speak to the CAM question. I actually think that I think there's a lot of benefit to the CAM disclosure if it's done right. I mean, don't get me wrong. I think there's some issues, but at a conceptual level, there are tough numbers. I mean, Steve, it goes to your point about FAS 157 Level 3 assays. The mere fact that FASB says you got to come up with a number doesn't make it easy and doesn't mean that there's not a range that takes you from A to Z. And it's useful for investors to understand that. And that's good for investors. It's good for preparers. It's good for auditors. And by the way, at a conceptual level, that helps you with regard to litigation risk. I mean, you're talking about challenges, you're talking about risks, you're talking about problems. The disclosure of problems doesn't get you into litigation trouble. It's the non-disclosure of problems that get you into litigation trouble. Now, permit me to just insert here, I was in the room yesterday when Alan Beller was speaking, and I accept that when you get into the weeds, there are some real issues, but that's really on the implementation. At a conceptual level, I would not suggest that you abandon the CAM project. Quite the contrary. I'm sort of cheering you on as a matter of concept.
I agree. There are benefits to the CAM, to the auditor's name. I agree with all of that. I think all of those, or I should say, the most important thing that can be done on the entire proposal is around these most important financial metrics I talk about. All of those are very helpful context as well. But in my mind, strengthening the robustness of the system for communicating financial performance is the most important thing that can be done.
Appreciate having the opportunity to weigh in on those, although again, haven't spent as much time studying them as we did this topic. But I have concerns about all three. Don't have to be fatal. But in terms of the first, in terms of CAM, so management already does MD&A, massive disclosures and footnotes. If you go to some of the big banks, just critical accounting policies runs on for 20 pages. So ours is a little less complex, but still runs to probably 10 pages. just in the main footnotes, get into MD&A, there's going to be even more. So how do we make sure that we're not confusing investors by auditors saying one thing? Now, presumably, the auditors would agree with our disclosures, or they wouldn't have signed off on the audit opinion, but now you get into words as opposed to numbers. And so the time that it would take to make sure that we're consistent, and if we're not, the idea that either the company did something wrong and therefore should have had a qualified opinion, or the auditors disclosing information that management should have been disclosing to begin with. And I do have some tissue rejection about the idea that auditors should be the source of original disclosures from about the company. But again, I think there could be workable things. I do agree that, as Mike said, FAS, the level 3 asset issue. And I've had audited clients who was a CFO for a firm that literally had 100% of their assets that were level 3. And did the users of those financial statements really understand the challenges in valuing those and the risk? Valuing them on any given day is tough enough. Trying to say what's going to happen between now and next quarter, virtually impossible. On the engagement partner, it's a tough one. From my view, I had audit clients. I had one of the largest audit clients in my former firm. I had 200 audit partners around the world that worked on that client. So, I mean, I can sign it, but geez, I'm relying in large part on those other 200. Do we want a laundry list? But I accept the fact there are other professions that do, put the individual's name on it. I just question whether does that have as much value as people might think, or is it misleading that there's simply one individual that's responsible for the audit. And then on the tenure front, could be a good disclosure. We do it. We do it as in response to a shareholder proposal. But quite frankly, my concern there is it's a data point that without some context to it can be used by folks that want to make a point. Well, we just shouldn't have long tenured relationships. Well, I guarantee you that audit, and whose name will remain nameless for the moment, but where I had 200 audit partners on it, imagine trying to get 200 audit partners in the new firm up to speed overnight on an incredibly complex business. So rotation is, tenure in my mind is simply the camel's nose under the tent of forcing the rotation discussion another step down the fairway, and I'm not sure it's the appropriate way to do that.
So CAM, as the written comments suggest, and my oral comments, very supportive of CAM. As to tenure, very similar to what Pete just articulated. It's a data point. Certainly no issue about having it be somewhere. Probably the proxy is the best place to put it to be able to provide that context. Partner identification, as we've communicated in our response letters to that proposal, we're supportive of transparency and letting everyone know who the partner is. Just logistical issues about whether it belongs in the report or if there's a way to do it and have that transparency without creating other issues.
Any last question? Go.
I had just one final question. And Pete, I wasn't exactly sure in your statement where you say a key performance indicator is assets under management. What's the auditor's role? What do you view as the auditor's role in
again, it's not a number that actually comes out of the general ledger, but it's a number that general ledger numbers are derived from. So assets under management, bottom line is daily we calculate our revenues off the assets that we manage. So there's, I don't know how many thousands of different fund products and separate accounts that all have different fee structures. So every day we obviously have this in a system, but there's also some subjectivity to it. Where my finance team has to effectively book revenues on a daily basis. So again, the auditors can't ignore AUM. It's the first part of the equation. So asset times fee equals revenue. On the other hand, AUM isn't subject to the same kind of double entry accounting system tension, or the same. It's subject certainly to our internal control system, but in a different way. But again, that's why I used it, though, as I think a good example. A little bit of what Jeremy's getting at is, that's a really important number, and it goes beyond the financials. Every month, the market waits with bated breath for my firm and all of our peers to announce what our AUM is, and it moves the stock immediately once that goes out. So again, it's something that I think having the market understand clearly what level of involvement the auditor has and doesn't have with that number is important.
But what do you think the level of involvement of the auditor should be in that instance?
Well, I think it already is heavy. So I think articulating what that involvement is, I think would be important.
We're at break. We're having a break. We have a great panel coming up. Let's take 15 minutes. Let's be back here promptly at 10:45 if we can. Thank you all. And thanks to the panel, extraordinary panel. Good morning. The panel, whom we welcome, includes William Touche, a senior audit partner of Deloitte in the London audit practice. He also leads Deloitte's UK Centre for Corporate Governance, and as a centre leader, follows developments in the UK regulatory environment, the listing rules of the SSA, FSA, and the developments of the UK Financial Reporting Council. William Touche is Deloitte's representative on the Audit and Assurance faculty of the ICAEW and also serves on its Corporate Governance Committee. Philip Johnson, the non-executive director of Yorkshire Building Society. Prior to joining that society, he was the head of audit quality and risk management at Deloitte UK. During his 30-year tenure as a partner at Deloitte, he was a board member, also served on the Structure and Risk Committee and Compensation Committee, and sat as the first chairman of the Audit Committee. Previously, he was the president of the Federation of European Accountants, a member of the International Auditing and Assurance Standards Boards, and the International Ethics Standards Board Consultative Advisory Groups. He serves on the Scientific Committee of the World Congress of Accountants of 2014, and he's a current member of the PCAOB Standing Advisory Group. Tony Cates is head of audit for KPMG UK and also for Europe, Middle East, and Africa. He joined KPMG in 1987, qualified as a chartered accountant in 1990, was promoted to partner in 1998. He spent a year on secondment to KPMG in Kuwait in the 1990s and has subsequently held a number of senior leadership roles in the firm, as well as serving a wide range of clients from owner-managed businesses through to through to the FTSE listing across a number of sectors, FTSE 100 clients across a number of sectors. Liz Murrow, Director of Corporate Governance and Reporting at Investment Management Association, the trade body representing the UK asset management industry. She monitors developments in corporate governance, companies' reporting requirements, assesses the implications for the industry, and where necessary, lobbies for change. She represents IMA on a number of committees, including the Institutional Shareholders Committee, the CBI's Companies and Financial Reporting Committees, the Corporate Reporting Users Forum. She is a secretary to a cross-industry group that liaises with the International Accounting Standards Board and the main accounting practices on reporting and auditing. Before IMA, Liz Murrow worked at a number of the main accounting practices, providing consulting services to a variety of financial services consultants. The experience and the expertise represented on this panel regarding changes in the auditor's report in the United Kingdom have direct relevance for us and what we're trying to learn. We appreciate your doing it. Please begin, Mr. Touche.
Well, thank you very much, Chairman and members of the board, for inviting us here today. So I'm going to give you perspectives from the point of view of a practicing audit partner who issued one of the first audit reports under the new regime, and that was to British Sky Broadcasting, the satellite broadcaster. I thought I'd touch on three areas. First, why I believe extended auditor reporting is so important for the future of the profession. Second, I'll share some observations gained from signing last year in July one of these first reports. And third, based on that experience, just a few observations on what works in the UK and some perspectives on what I perceive the challenges will be for the second year of reporting, because I think we're all very excited about the first, but actually the second is also we need to have a view on. So to start, I thought I'd mention that I wouldn't be here today unless I was a big fan of the new regime. However, a lot of the success of the regime in the UK is because at the same time as introducing the new auditor reporting, the FRC also introduced new requirements for boards and for audit committees. For boards to make two statements. First of all, that the annual report is fair, balanced and understandable. And second, that it contains sufficient information to explain the strategy, business model and performance of the company. So in addition to these new requirements for the audit committee in its own reporting to shareholders, that they should examine the scope of the audit and explain in their report to shareholders the key issues that they considered and how they were resolved in respect of the financial statements. So, and I know this is a hot topic here, in my view, this quite properly puts the communication responsibility for financial statement judgments on the company rather than the auditor. And it also highlights and reinforces the role of the Audit Committee in supervising on behalf of shareholders the production of the financial statements, the supervision of the scope of the external audit, and the resolution of key issues raised by the auditors, and doing that on behalf of shareholders. So second, just a few introductory contextual remarks about Bskyb. It has a reputation as one of the most successful and innovative companies in the UK, well led by a management with a focus on its core mission. And in common with many consumer-oriented companies, its focus and clarity is reflected already in its annual report. So I was very pleased when the CFO and the CEO, Andrew Griffith and Martin Gilbert, and Martin is a significant investor, he's the chief executive of Aberdeen Asset Management, a major institutional investor, agreed to take a lead in early adoption. So first, the importance of the new external audit report. So I've been a partner for about 18 years at Deloitte. We employ 15,000 people in the UK, and we recruit about 700 graduates into the audit practice, all hugely talented people, and most of whom will use their training in audit as a springboard for successful and fulfilling careers in finance and business. Now, for these people, the fact that the key matters we address in our audit work are now directly described in our public reporting is actually rather inspiring for our new auditors. They're proud to see their work so directly described in an audit report. It underscores the public interest nature of our work at a time when the profession has had a pretty rough ride. It invigorates their personal sense of responsibility and pride, and it underscores to them why quality is so important in everything that we do. So from the perspective of Deloitte UK, we see the audit report as an opportunity to inform shareholders about the important work we do on their behalf. We're appointed by shareholders to form our view on the overall financial statements, but commenting now on the major areas of focus of our work actually seems quite natural in the public domain, even just a few months of the new reporting regime. So speaking as a member of the profession as a whole, thanks to the leadership of the FRC and the good work of many others, I think we've been given an opportunity to re-establish the value of audit. And of course, without being too sentimental, London's pretty proud that we've taken a lead out there. Just as also we've taken a bit of a lead on our comply or explain governance model, which has helped governance regimes shape around the world, led by the FRC, the ICAOB and the EBRD as well. And that's an important part of the reporting structure. So what were the experiences of the new extended auditor reporting? As I said, Sky embraced this from the very first suggestion. The attitude of the company is very much, if we can lead, then we will. Now, the new audit report drives auditors to describe the areas of focus that consume audit effort and the matters that we chose to report on: revenue recognition, the recognition of programming costs when they're expensed, and the validity of capitalization of capital projects are those that do consume our audit effort and are areas that are routinely discussed with the audit committee. So the topics were already well aired, and there should really be no surprises for management or for the audit committee on any of the topics commented in audit reports. So from a communication perspective, there's a bit of a breakdown would have occurred if there are surprises at the 11th hour. And the next question I thought would be of interest: if the topics are understood and well aired, were the words difficult to find to describe them? And in fact, this proved to be uncontroversial. Sky is hugely respectful of the work of the external auditor and of the reporting we have to make under the standards that we follow. So we had very little discussion about the choice of words. But in some companies that perhaps may be less respectful of the audit, maybe the auditor's latitude that provides a much more potent voice now with the new form audit report actually should engender greater respect for the role of the auditor and for the profession, and probably greater engagement with the auditor by management and the audit committee. And I expect this will be one of the positive outcomes from our new regime. I thought one of the challenges would be to figure out how many issues to report and the level of detail. But again, this proved to be quite uncontroversial. We actually, I have a keen focus on trying to keep comments succinct. And again, with a focus on year 2, I think succinctness will be a benefit. I've had shareholder representatives comment to me that it would be very helpful to flag in year 2 what has changed. So following the less is more principle when describing the audit risks and responses would be a very good principle to adopt. So to summarise, a few ingredients for success: early discussion and communication, the company's robust governance that respects the role and work of the auditor, and remember that the audit report is about succinct communication with investors. I think the one challenge to be faced in the coming year is the proposed reporting on the internal controls. And you've obviously had internal control reporting here established for longer than we have. Under the proposed changes, it will be very interesting to see how our free-form audit reporting develops. So a few final lessons. One, boilerplate disclosures are public enemy number 1. Innovation and company-specific tailoring could be stifled by requiring specific ordering or prescribing standardized language. And you can achieve comparability by achieving a limited number of defined headings, allowing freer form reporting under each. And we're seeing in the UK a wide variety of practice emerging both between firms and between individual partners. I personally like our opinion, which focuses on the audit effort rather than leaving the audit committee to explain the judgments. Our opinions on the statement as a whole, whether they show a true and fair view, it's up to the audit committee to explain their scrutiny of management's judgments. And I think there needs to be real care and attention in explaining audit procedures. I don't think we should be going into a long laundry list of audit procedures. And finally, and perhaps the most important point, is we're very lucky to have the governance regime that we have, where the audit committee itself and the board has to make these statements, which, if you like, our auditor reporting regime complements. So I hope that's been a helpful commentary, and it seems better for the panel discussion.
Thank you. Mr. Johnson. Philip.
Thank you, Chairman. Thank you for... beg your pardon. Sorry, technology. Thank you, Chairman, and thank you for your kind remarks and also for inviting me to speak here today. I'm here in my capacity as an Audit Committee Chair, thus representing part of the non-executive director community, but I've also had great interest in seeing the audit profession move forward. Having spent 30 years as an audit partner in a Big Four accounting firm, during which time I helped develop communication to audit committees, had 6 years in Europe representing the accounting profession, discussing changes to our profession and the auditor reporting model. And now as the chair of one audit committee and a member of another, at last I can say that we've finally started to tackle the long-standing information gap concerns which for so long has been described by stakeholders as an expectation gap. You heard comments yesterday about how long it has been since there was a change in the auditor's report. 80 years was mentioned for the US, and Nick Land commented about 150 years in the UK. This 150 years goes back to the middle of the Industrial Revolution, when trade expanded, companies got bigger, and external capital was sought in ever-increasing amounts. The owners were not the managers anymore, so the audit, as we know it, was formulated to give assurance to the owners that the financial statements properly reflected the company's financial position. So having said that, it is quite clear to me that the purpose of the audit is for the auditor to inform the investor. Thus, the need to provide more than just a pass-or-fail, recognise that the pass-or-fail model is fundamentally important to the investor. I appreciate that the UK has a different legal system and a different litigation environment. We also have a set of principles-based standards rather than the rules-based approach. The new audit reporting standard is only 16 pages long, including the application material. And therefore, the auditor can use his judgment as to how to report on the requirements in the standard, quite different to what is normal here in the US. We heard from Nick Land yesterday that the new auditor reporting model in the UK caused some tensions between auditors and management. When I was working in Brussels, it was stated at one point by the European Commission that they wanted to create some tension between the audit committee and management in order to create better corporate governance. The question must be, is it tension or is it challenge? If it's the latter, then it can only be healthy, and for the audit it can only result in a better quality audit. So with this backdrop, let me focus a little bit on what happened in the UK. As William mentioned, the FRC, encouraged by Parliament and investor groups, firstly looked at the Corporate Governance Code for company reporting, focusing on the role of the Audit Committee and what it should cover in the Audit Committee report. And then, as an audit standard setter, look for changes to the audit report. To give credit where credit is due, by looking at both Audit Committee reporting and auditor reporting, the FRC have addressed or moved a long way to addressing the shortcomings of two of the three legs of the corporate reporting stool. The third leg is the financial reporting framework, which is also needs some changing, but 2 out of 3 is a good start. This is why I think the SEC and FASB also have a role to play here in the US, and not just leave change in this area in the hands of the PCAOB. Turning to my personal experience of the changed environment in the UK, let me focus on the company where I chair the Audit Committee and what, if any, were the differences in reporting I've seen as a consequence of the changes. By way of scene setting, we are a financial institution, the second largest building society in the UK, with $55 billion of assets. We are involved in savings and loans, but also have a regulated financial advice business, have some complex financial instruments, undertook 2 significant mergers during the financial crisis, and account under IFRS. As a consequence, we have a number of significant judgments to make each year, and also carry some significant risks. So at December 31st, what did our auditors report on? Well, let me start by saying their comments were mainly on the risks which could result in material misstatements in the financial statements relating to critical accounting policies and estimates, and the judgments made by management. Firstly, let it be said that the audit opinion, i.e. the pass or fail opinion, came right up front in the first paragraph. So no confusion there, which was a concern expressed yesterday by some presenters. They made specific comments about going concern and the work that they had undertaken, but also had to comment whether they had identified any material uncertainties that cast significant doubt on the group's ability to continue as a going concern. They had to define materiality and the level of audit differences that would be reported to the Audit Committee. That was covered yesterday, so no need to say more now. The most significant change, however, was the requirement to identify the areas of risk that our auditors consider could give rise to material misstatement in our financial statements, and how the audit scope responded to those risks. Our audit, the risks identified were loan loss provisions, particularly important due to the change in economic levers, fair value adjustments, and an important judgment as we set those provisions a few years ago when economic conditions were quite different, revenue recognition, provisions for customer remediation as a result of some legacy and current issues identified by the regulator, where we had to make provision for future payments to our customers and potential fines to the regulator. Capitalization of costs, we are undertaking a very significant upgrade of all our business systems over the next years, with both internal and external experts, and totaling hundreds of millions of pounds. Hedge accounting, treasury instruments where there is no active market, and deferred taxation. Again, reasons articulated yesterday. You can see from this list that the risks require the company and the auditor to exercise a high level of judgment, and all or a combination of any two or more could have a very significant impact on the reported profit and the financial position of the group. As a financial institution, those matters were seen to be useful to the understanding of our financial position. In the Rolls-Royce audit report mentioned so often in the submissions yesterday, the risks identified centred on revenue recognition, recoverability intangibles, accounting for subsidiaries and associates due to the many collaboration agreements, liabilities arising from sales financing arrangements, bribery and corruption, and presentation of underlying profit. Very important to understanding the Rolls-Royce position, so tailored to that company's circumstances, but quite different from those disclosed in my financials. So what about the audit committee and the audit engagement? Was there any difference? Compared to previous years, there was certainly more engagement between the members of my audit committee and the auditor. This was partly due to enhanced audit committee reporting, but also due to the changes in the audit report. Both were new requirements in 2013. We had common interest to say what we had done and why we had done it. There was early engagement and improved dialogue during the audit process. The audit committee were more engaged during the audit planning phase, focused heavily on key matters within the financial statements, and were far more engaged with management and the auditors to ensure appropriate judgments were being made and that the reporting of these judgments was appropriate. There was more detail provided by the auditor to the audit committee as how they had satisfied themselves on the key judgments, and there was more challenge to management. As far as the audit team were concerned, the members were far more aware of what was important in the business, and they seemed to show a higher level of scepticism and overall challenge whilst doing their work. So let me make some concluding remarks. From my experience across two audit committees with two different audit firms, I am certain that the quality of the audit was improved as a consequence of the changes brought in by the FRC. It also helped us move away from boilerplate reporting. Every company is different, so the risks and significant matters identified need different disclosure. I don't subscribe to the notion that the auditor will revert to boilerplate. There will be refinements made in the future, but I think the auditors recognise the need to inform, not just comply. Another added value as a result of better auditor reporting will be that across a number of years, stakeholders will be able to identify any changes in the risk profile within a company. Another helpful piece of information to all stakeholders. Nick Land mentioned that he did not expect to change next year in the Vodafone audit report. But if there was a change and new risks were emerging, then that really is information worth having. Another positive is in relation to identifying or helping identify sector issues. Analysing audit reports across particular sectors can inform on emerging issues. We tend to focus on the concern over company analysis of competitor disclosed information. It could be that when you do the analysis, one company stands out as an outlier, thus prompting questions to be asked. So let's focus on the positives coming out of enhanced reporting, rather than have a fixation on the negatives. We need consistency, however, in auditor reporting, irrespective of the jurisdiction where a company resides. It would be better if we could have just one reporting model across all jurisdictions, but the current PCAOB proposal helps us move closer together. I think looking at the risks rather than looking at the effort should be considered by the PCAOB, but no one party will get everything right first time. We will improve matters and regulation will evolve just like everything else. Darwin said, evolution is a given. We should all take heed of this and evolve. If the US does not embrace change, I'm sorry to say this, but in my view, it would be nonsense if the largest capital market on earth provided the least amount of information to the investor community on the key matters influencing the financial information on which those investors are making their decisions. In the UK, in the rest of Europe, and internationally through IAASB, the wind has changed. Let us sail in the same direction, and I would encourage the PCAOB to move forward just as the rest of the world is moving forward.
Thank you. Tony Cates.
Thank you, Chairman. Chairman, it's my guess that when Nick Land and our UK regulators chose an accelerated timetable for our review of audit reporting, that was because they wanted the UK experience to be something that others could benefit from. So I'm very happy to be here today and to talk about what we've been doing in the UK. And let me start by saying, why I think that reform was needed. The catalyst was obviously the financial crisis, but perhaps this just brought to the surface an issue that had been around for some time, a decline in shareholders' trust in companies and in audit. Audit should have been playing a key role in creating trust between shareholders and their companies, but it became apparent that it wasn't delivering all that it could. Now, to me as an auditor, the value of an audit is very clear, but to the shareholder, the binary audit opinion just wasn't delivering it. So I think it was absolutely right that we needed to make a bold move on a long-form audit report to say what we thought the issues were and what we did about them. After all, auditors are for shareholders. So shouldn't we deliver more of the value that comes from our work directly to those shareholders, not just via the audit committee? Now, in terms of putting that into practice, it may be easier for the UK to do that. In UK law, our audit reports are for and addressed to shareholders as owners only, rather than as traders of shares, using the audited accounts to hold directors to account. And that's not necessarily the case elsewhere. Now, in practice, my biggest worry was a short timetable and a very short auditing standard, just 5 paragraphs. However, there was wide recognition that the regulator had laid down a challenge to use those few words to show the value of audit. And with the UK's less fiercely litigious environment, it was easier for us than perhaps it may be here to respond to that challenge on the basis of just 5 paragraphs. Essentially, we did that by learning on the job on our September year-end reports and converting that experience into firm-wide policy and guidance and rolling it out across the firm with a central team to provide support and a measure of consistency in our approach. So what was the critical deliverable for us? We saw that as a description of our work on the key risk areas, and it's this, not say the materiality figures which were also required, that really demonstrates the value of audit by showing how we brought our experience and independent mindset and skepticism to bear. That demands that we flag the key things that we had to test. So not just that you had to test the subjective assumptions in the risk area, but specifically which assumptions. And not just that you tested them, but how you applied your outsider's perspective, whether benchmarking against data or against your own views of, say, growth potential in the sector or for the specific client. When we did our KPMG survey of first movers, and at that point only 19 companies had reported in mid-January, this was the area where we found most variety. Not surprising for the most difficult aspect of the new UK reporting. The UK's new reporting, by describing some of our audit procedures, inevitably begs a question. What more can the report say about, for example, what the auditor found in his testing? At KPMG in the UK, we thought this question shouldn't be left hanging, but should be tackled face on. So in order to promote a debate about that, about the value and about the challenges, we've tested out the idea in a very small number of reports, and we've heard about that just earlier, by also giving the findings of our work in each risk area. That debate has only just started, and I'm not here today to promote any kind of position on that. But I do think that you and your stakeholders as you debate the way forward for the US, you might want to have one eye on the question of where it could lead in the future. So back to the existing reporting model in the UK. Is it a challenge to do this kind of reporting? Yes, it is a challenge. Is it worth doing? Absolutely yes. But at the same time, we shouldn't fool ourselves that better auditor reporting is the answer to preventing future financial crises. It can only ever be part of the solution, and focusing on the adequacy of corporate reporting, of corporate governance and stewardship are all fundamental prerequisites, without which improved auditor reporting will mean nothing. Thank you.
Thank you. Liz Merle.
Thank you, Chairman, and good morning, and thank you very much for inviting me here. I very much welcome this opportunity to give an investor's perspective of the changes the FRC introduced to audit reports in the UK and the improved transparency around the audit process that we now have. I'm here on behalf of the Investment Management Association, the trade body for the UK asset management industry. Our members include the asset management arms of the investment banks, the retail banks, the insurers, the managers of occupational pension schemes, and independents. We have around 220 members in total, and collectively they have about 4.5 trillion of assets under management globally. 67% of those holdings, however, are held in companies listed outside the UK. They're held internationally. This means that our members are major investors in companies, and they have an interest in the requirements governing the preparation and audit of these companies' accounts and the information disclosed to them as users. So what do investors want from the annual report and accounts and the insurance and audit of that information? Essentially, the accounts are a confirmatory document published some time after the events to which they relate. They're about management's accountability to its investors, the shareholders who put up the risk capital and bear the residual risk. Management is entrusted with shareholders' funds, and corporate reports should show how those funds are put into use and the performance derived from them. Accounts show the accountability or stewardship of management. The fact that these accounts are subject to an audit is vital to investors' confidence in those companies, in that markets value the information and investors believe what they're told about their investee companies. If that presumption was exposed as faulty, then the system could seize up. Nevertheless, investors have had concerns about the quality of the audit, the auditor's accountability and transparency to investors for some time, certainly well before the financial crisis. Many of these concerns were a product of the fact that investors felt excluded from the audit process and the real findings. They were largely invisible. And whilst, as we've heard, the binary opinion, pass or fail, is very important, the audit reports otherwise tended to focus very much on details of what the auditor did not do rather than what they did. It's been said that 91% investors do not read audit reports. I don't think that's surprising given what's in them, but I would actually refute that. I think investors do look at the audit report, but it's very quick just to see whether or not it's qualified or not and who did the audit. All this did the profession a disservice, and some investors were questioning the value of the audit. This needed to be changed and trust re-established. Tony had mentioned trust in his opening statement. The FRC's framework was a welcome part of that change in introducing a more enlightened audit report. This was a big leap forward. It's the most significant advance in auditor reporting in decades. And a challenge has been thrown down to auditors and a competitive edge, if you like, almost, introduced into audit reporting. And whilst the 30 or 40 examples of the new style reports are quite mixed, this is an evolving process, investors are very positive about the changes. So what has changed? First, the FRC requires auditors to disclose audit materiality. This should mean that investors are better able to assess the quality of those reports. Currently, we have few indicators or no indicators of that. Most importantly, the new audit report tells investors what the auditor assessed as we've heard, the main risks of material misstatement, effectively what the critical accounting policies and estimates were. What is important here is that it's not a kitchen sink approach, but a risk-based approach. Investors don't want a laundry list of procedures. What they need to know is why something was a risk of material misstatement, what the auditor's response to that risk was, and also what the outcome was. This information will help investors identify and understand the significant judgments in the accounts. It gives them a hook to further challenge executive management and hold the audit committee and external auditor to account. This greater understanding should contribute to the relationship between management and investors, enhance trust, and ultimately, in the long term, reduce the cost of capital and increase the value generated for investors and the end beneficiaries, their clients. So what have we found? Well, the requirements were effective for accounting periods starting on or after October 2012. And I think it was commendable that certain companies adopted early. As William has said, Bskyb did, and also Ashmore and Vodafone. I think Vodafone was producing annual reports in accordance with this while the ink was still drying on the revised standard. Concerns were raised yesterday whether the information could be market sensitive. As I've said, the main role of accounts is as a confirmatory document to the market. They're historic and produced some time after the period to which they relate. The information that is price sensitive has to be disclosed under the market abuse regime. And as for investors' decisions themselves, they're more likely to be made around the preliminary announcement or investor roadshows than through the accounts. But the key thing and the important thing is that all this information that is out there can be tied back to the accounts and that these accounts have been independently assured. There were also concerns yesterday whether this reporting could result in mixed messaging. We don't believe that is the case, and we haven't seen that to date. I think it's important to remember that the preparation of the accounts is the responsibility of the company and its board, and they should make the necessary disclosures about the company's position and performance. As regards the transparency we're discussing here, only the auditors can report on what they actually did and what they found. However, one of the concerns that we did have is whilst the FRC's requirements tells investors of the key risks and how they were addressed in the scope, I think many of us are asking questions why it didn't go further and ask, what did you find? How aggressive or cautious did the auditor find the company's estimates or judgments? This is something that's already subject to a dialogue between the audit committee and the auditor, and investors would value this insight too. And I think we've heard that there are certain reports, and there are two that I can name, Rolls-Royce and New World Resources, that have actually gone that step further and reported what the auditor found. Lastly, several standard setters are looking at proposals to change the audit report. As I said at the outset, 67% of all equities managed by our members are held internationally. Investors want harmonised international standards for audit reports. And whilst we recognise there is some consistency in a number of the proposals, unintentional and unnecessary differences should be avoided, and as Philip has said, we would encourage the PCAOB to follow the steps that have been taken internationally. To conclude, investors have had concerns about audit quality and the transparency of the audit process for some time. Steps are being taken to address this, and the FRC's package of reforms enjoys the support of the investment community, the real end clients of the audit process. Thank you.
Before I recognize Jeanette Franzel, let me say that while delivered in a very understated British way, these four statements contain bombshells. They are, in fact, terrific statements. Jeanette?
Thanks for coming today and sharing your insights and experience. This is very valuable to us. A couple of you made comments about the need for international or for standards to sort of come together internationally. And we've got KAMs, we've got CAMs, and we've got the UK approach. And so I'd be interested on your views as to maybe the risks that we're currently facing and how can we bring all of these proposals closer together. But also, I'd like to hear about advantages and disadvantages that you've experienced from the UK approach that maybe we should think about as we move forward with our proposal. So start with Mr. Touche.
Looking forward to year two, I mean, if you look back at year two and you've got a huge amount of variation across border, and we've got significant variation in the UK with companies or firms or partners doing different things, I think it could lead to some frustration. So I would encourage standardization with the user in mind. So anything you can do to harmonize and lead with all these various definitions and drive an international consensus would be very, very helpful with the user in mind.
Any advantages or disadvantages from your experience that we should keep in mind?
I mean, from a perspective of the dialogue with companies, which is, you know, the source of my invitation today, I think the primary responsibility for commenting on judgments, as I said earlier, should be with management. Now, as I said, we're blessed with a regime where the Audit Committee is required in the UK to report on judgments. And I think that regime does not exist in many parts of the world, including perhaps as much as you would like here. So I would encourage some evolution of the responsibilities for audit committees to report on key judgments in relation to the financial statements as part of a package of measures.
Just from my perspective, I think some commonality is a good thing, but actually we are operating in different environments, and having, learning from each other as we evolve could also be seen to be a good thing. So that there would be some positive things about having slightly different approaches. I think in the UK, the short, brief kind of overview standard, the 5 paragraphs that I referred to, actually enabled us to be quite innovative in the way we were doing things. And so different partners and different firms have taken slightly different approaches, and I think that's benefited all of us actually, because it will help us to evolve a much better product in the long run.
I think in terms of trying to align the requirements internationally, I think what we've seen from the European Commission and we've seen from the IAASB and the FRC is they're actually focusing on things like material misstatements, significant risks. So it's getting away from ensuring that we have a sort of laundry list of issues. And I think that would be very helpful. And just the terminology itself is going to could potentially confuse the international markets if that could be aligned. As to the advantages and disadvantages as to what we've seen in the UK, I mean, I think there have been a lot of advantages in terms of opening this opening this black box so that we can see what happens in the audit process. And I think that is going to help the dialogue between auditors, management and investors going forward. But the potential disadvantages is potentially, as we heard yesterday, as to whether or not this could become boilerplate over time, and if it's not read, then it's not going to be any use to anybody if that does happen. I think there are various safeguards to help that. The fact that the standard itself is very high level and principles based and gives the firms a lot of flexibility in terms of what they're reporting. And also we're seeing a lot of sort of change in the audit process. There's been a lot of pressure and there's been sort of regulatory proposals for mandatory rotation and tendering. So we're going to have more change of auditors, and I think that will bring a fresh pair of eyes to this reporting and change this. And of course it is it is different in the UK in that we have a different sort of corporate governance regime. We operate very much under company law, with shareholders having certain rights to monitor and respond to what happens in companies, and a very strong role for our audit committees, which is not necessarily shared internationally. Thank you.
Jay Hansen?
I was only just going to add the point that when and Marty was also on the IAASB CAG, and when they were talking about this project for ISO 700, they were coming up with all manner of things, and I think that they took on board, I think, that the auditor can't second guess what all the stakeholders will want to see from the audit reports. And I think that is absolutely critical. That what is reported is useful information, but doesn't lead people down the road through the financial statements and pinpoint certain things that you ought to look at. You have emphasis, if something's so important, you have an emphasis of matter paragraph. But I think that you do have to be careful that you don't take away from the user the ability to read and inquire. And that was a good move, and I think that evolved through the process. So all I would say, as far as the PCAOB is concerned, it is good not to be too prescriptive, and good not to, as the chairman was talking about yesterday, leading the witness.
Okay. Question for the gentlemen that have actually had to do this one time now. It's a two-part question. One is my observation about the ability to describe the risks, the materiality, and then the scope of the audit, how it addressed the risks, that for the well-organized, proactive engagement team, that could pretty much be done at the time you completed your planning for the engagement. And look back at the end to say, well, gee, did anything new come up for new risk or anything unintended that we need to change how we've described the scope? And so just want your thoughts. Did I get that right? That's effectively what, and setting aside maybe the first year of implementation challenges, but that's directionally what your new standard is suggesting. But then also to connect to something that Ms. Myrtle said, that's one level of helpfulness for investors, but the more helpful thing is going to be, so what? What did you find? And maybe your thoughts about the practical implications of how difficult that may be to, at the end of the engagement, then describe what did you find.
I think in terms of the actual risks, all we're really doing, to some extent, is describing the risks that we describe to the audit committee at the outset of the audit, and we monitor them through the audit, and we focus our attention on them, and we comment to the audit committee on them at the end of the audit. And in some sense, it's a frustration, or has been a frustration, that actually we have that focus and that debate and really focus on those risk areas through the audit, and then historically just come up with this binary audit opinion, and no one really knows what we focused on. So actually it's been a release in a way to be able to say, actually these are the things that we did focus on. And ordinarily, and for well-run businesses, you will find that you know what those risks that you expect to be at the outset, and you follow them through, but you're also ready to be flexible at the end and to be skeptical about what new risks might come up towards the end of the audit. So I think that ties in very well with the audit committee reporting, for sure. Now, the second part of your question related to the so what question, and we've released, KPMG have assigned 2 reports now, the Rolls-Royce report and the New World Resources, which Liz mentioned, where we have put some additional commentary on. It was with some trepidation that I authorised those approaches, and it is one audit partner that has done that, and we've spent a lot of time thinking about that. And I'm not really, we didn't do that with the intention of doing that in a more widespread way. We did that with the intention to really be bold and to start a debate. So we haven't really decided where to go with that in the future, but clearly it has kicked off a debate. I think, again, all we're doing in that situation is being even more open about the type of discussion that we have with the Audit Committee, because we would always have that sort of discussion as to how, the level of judgment involved in provisioning and where the company sits on that. I do feel that it might be it will be difficult in the it'll be difficult in the short term, shall I say, to actually do that with a wider number of companies. But I'm glad we've kicked off that debate at least.
So yes, for sure, in the transition year in particular, most of our clients wanted to see what the audit report would look like before we had done the path. So yes, when you present your planning paper, the chances are most of our partners have also presented an outline of what it might look like. And that's just good communication. It allows the annual report to be constructed in a cohesive way. It allows the Audit Committee to start thinking about how they're going to describe the key risks and judgments that they're responsible for making, so that they can start thinking about their language and so on. So that upfront communication is essential. If there's fear in transition, that de-risks and removes quite a lot of that fear in that transition period. Just coming back to the so what, and the commentary on individual judgments, as Tony said, I think there is a debate to be had that's only just beginning. And of course the fear is that by commenting on individual items in the financial statements, you take away from the true and fair view as a whole. It clearly provides colour to that, because there is a range of judgments that all add up. We were just talking with Liz earlier. The problem is if you go down this path and you say, oh, you could have done this, you could have done that, or it's a bit cautious or a bit aggressive here, investors, of course, will want to know, well, supposing you added all that up, what would the impact be? And then you get an alternative set of numbers. So this debate will run its course. I hope that we'll end up with an opinion on a view that reinforces the opinion on the financial statements as a whole, rather than a whole list of individual opinions on individual judgment areas.
Can I just make one point from the Audit Committee experience? Certainly, when we had the report from our auditors to the Audit Committee, they did, because of all the areas that they were covering, they did put us onto a spectrum. So each individual item that I commented about before, whether it was loan loss provisioning, whether it was fair value, etc., and certainly valuation methods and results, that there was all those are on a spectrum. We found that as a board, well, as an audit committee, and then subsequently that was taken to the board. We found that very useful to assess where we were compared to our peers. Because the auditors did have insight of what was happening in the market, what was happening in their class. So we were much more comforted by the fact that we had that information available to us as a board. Now the question then is, should that be rolled out? I am very much aligned with William, with having some caution about having a whole series of mini opinions. The audit opinion is for the financial statements as a whole. So if we're actually, it depends how far it goes to what is described, because I wouldn't like to be in the position where every major judgment area on my balance sheet had a mini opinion on it. But I think it is, a debate that needs to take place, and I know that there's already started. And the interesting thing for me is that we're now only, we're 6 months in. That's all we are, 6 months in. There's only been 40, 50, whatever number of reports have taken place. And already the auditors are starting to talk about what more they can do, what more information that they can give, rather than go the other way around and saying, well, after the first round, perhaps we went a bit too far with this or a bit too far with that. So I think that's an interesting dynamic as far as the audit firms are concerned, is that they're looking to move it forward even more, whereas in the past there's been reticence to do anything. And so I think that's encouraging. And certainly from an audit committee perspective, we like to know where we sit on that spectrum, and we don't want to be, we are a conservative financial institution, so we don't want to be having racy policies and racy judgments, and it does help us to ensure that we're not in that space.
Thank you. I think investors do want to know where management's judgments lie and what the audit work that was done on that and the assurance gained by it. And if we look at the requirements as they stand, the Audit Committee is required to report on the significant issues and what they did. The Auditor is required to report on the risks of material misstatement and what they did, but no one's required to report on what they found. Investors want that information.
Thank you. Lewis?
Yeah, as I understand it, at the present time, these requirements are limited to a subset of public companies, whether it's the FTSE 350 or whatever it is, I don't know, but it's a subset. So I have two questions. One, what do these new requirements do to audit costs and or fees? And two, will it be and should the requirements be expanded beyond the original subset of companies? Should they be applied to all public companies, for example, or all audits?
In terms of, you're right, it's limited to companies actually that comply with the combined code, which is largely the FTSE 350 and some others that comply voluntarily. In terms of cost, I heard Nick Land say yesterday that he didn't think there was any cost. I mean, I can assure you there is some cost. It's not so much getting the issues together. We've already got those issues together for the Audit Committee, but it's actually, drafting the statement, having some form of quality control over the audit opinion. So at KPMG in the UK, we issued around 80 opinions in total, and some in the future. And actually, we had a centralised process, and we set aside not just our technical people, but some of our best client-facing partners to also review those opinions so we could get some best practice. So all of that costs, but it's not a huge cost.
Were those passed on in higher fees?
And in many cases, yes, they were passed on in higher fees, but not. I wouldn't say that significant fees. Should it be expanded to other companies? I mean, I think it covers the main companies that investors are invested in. Is probably more a question for Liz than me.
Yeah, it covers all companies that are required to adhere to the UK Corporate Governance Code. That is the premium listed segment in the UK, and that is the main UK listed companies. I suppose one of the concerns that I do have is increasingly we're seeing overseas companies come to the UK to list, and they have significant operations in countries that may not have the same auditing standards, and it's how they're going to actually adhere to this going forward. I think that could be a difficulty for them because you need uniformity in the list. As regards the costs themselves, as regards investors, auditors are scrutineers on behalf of the investor community. We don't have any issue with audit costs, although obviously we wouldn't want to see any cost increases should be reasonable. But I think in terms of that, particularly the increased tendering we're seeing, I think there is a concern whether or not the audit tenders could compete on cost, and I think it's very important that that process is owned by the Audit Committee such that cost doesn't drive the decision and its quality. Thank you.
I echo what Tony has said, and I think it's worth just bearing in mind that the auditor reporting regime was introduced with a package of other measures for boards and audit committees. So that helped, if you like, in the whole company redesign of annual reports in the last 6 months, for which, yes, there has been a modest additional fee, but as Tony said, not enormous.
Our fee went up really marginally. There was no significant increase in those costs. Certainly as far as the company is concerned. I don't know whether the auditors will be looking at their margins next year, having gone through the experience and how much time they did have to put into it. But certainly from the first year that we experienced it, it didn't increase the cost. Whether it should go any broader, in the UK, of course, there's a large number of companies other than the FTSE 350 that are subject to audit. From a personal perspective, if you have stock listed on a stock exchange, then why shouldn't you give this, or why shouldn't the auditor give this information? You can easily lose money. The investor can easily lose money on small companies as they can with large companies. So I think it's not necessarily a size, from my perspective, it's not necessarily a size issue. It's the fact that you have external shareholders investing in your company, and I think that you have to have that mindset. A lot of the companies, if it goes down to private companies, which in the UK a number of private companies do, it is mandated to have audits, then when you've got management and owners as a small group, I don't think there is a need to do it across the whole spectrum.
Steve Harris.
Well, Mr. Tooth, first of all, I commend you on your testimony. And when you say without becoming too sentimental, I don't think you were at all sentimental, but I do think your testimony was extraordinarily powerful, especially in light of the testimony we've had the previous day. And the way you grasped at the opportunity and the pride that you took in your profession, and the way you relished the challenge to reestablish the value of the audit, and the public interest nature of our work, and how it invigorates their personal responsibility of the auditor, and how important it is that what you're doing on behalf of shareholders. And if we can take the lead, we will. I think that view was shared by all of you, but I just want to say that is in juxtaposition to some of the comments that we've heard the previous day, and I, for one, very much appreciate the understated way that each of you communicated that message. I guess I have two questions. One, you all speak about investor groups and the outreach to investor groups. And Liz, let me take you out of this conversation for a moment, because you are generally viewed among the investor constituency as an investor advocate. And I say that from my perspective in a very positive sense of the word. In the United States, investors are often criticized as not having any idea really what they want, not speaking with one voice, not having a bottom line, and the profession being unable to glean what investors want. Two parts of the question. One, could you describe a little bit of your investor outreach in the UK? Who are these investors, and how much money do they have under management? And second of all, do they speak with anything even remotely approaching a unified voice in terms of what they want and in terms of a bottom line?
First of all, thank you for your very kind comments. I think we're all very pleased to be here to make a contribution to your debate. Yes, we're very lucky. I mean, London is a very large capital market. All of us who are practicing in London, head offices of the big four firms are all located within, probably half an hour's walk of most of the investor group's offices. And there are probably only 10 or a dozen people that we need to know. And we are in very regular contact with the representatives of the investor group, of which Liz is one. So There's been very strong and open dialogue, both between the firms and the investors and the regulators and the investor groups. And that dialogue has been not necessarily in plenary forum, it's been one-to-one. We've been exchanging messages and emails and all the rest of it with people as this thing has evolved. So it has encouraged an open dialogue. As far as our firm is concerned, 2 years ago we instituted an annual general meeting where we invite stakeholders, the public interest, to come and hear what we're doing on audit quality and innovation and all those other things. So we started that a couple of years ago. That's gone down very well with the investor groups. And it's their opportunity to quiz us in the form of an annual general meeting about what we're doing. So that's part of our public interest agenda. As far as engagement with the companies is concerned, which I think is the other part of this question, I think this is all quite new. Liz mentioned earlier that we've had the remuneration regulations all changed, and investor groups have been very distracted by that. It's taken up an awful lot of time to form policy with companies. We are now waiting, and companies are now waiting to see how investors will engage with this huge amount of additional information that they have now received. But we know in advance that, for example, the corporate governance teams have been relocated in many instances to sit alongside the fund managers. So there's been more integration in some of the investor houses, so that their joined-up dialogue is brought to bear with the companies. And then the other feature about the UK regime is that we have the FRC is also responsible for the investor code, which is the stewardship code, to encourage investor groups to reach out to their investee companies. So we're fortunate that we have the one regulator responsible, if you like, for all angles in our little dynamic within our the City of London, where we can walk to each other's offices.
Just a couple of things to add from me. I mean, I think things are changing. I hosted a round table of FTSE 100 Audit Committee chairs a couple of years ago with some investors, and actually to a person, they'd had no investor had ever talked to them about the audit, where they said their remuneration committee chairs were always being asked to go and report on remuneration. They hadn't had the discussions around audit. Now that was a couple of years back, and I'm hearing now that that's changing. Part of that due to part of that interest in audit reporting, I think, is changing that, and part of that is the kind of EU audit reform and rotation and tendering, and we're seeing investors, from my perspective at least, getting much more interested in audit and what's happening in audit, which I think is a good thing. After all, it's the investors who we report to.
Can I just, I just wanted to pick up on, not to repeat what's been said, I'd like to pick up something that William said, and that was about dialogue. I think in the UK, what we have found is that over the last 4 or 5 years, perhaps even longer, that firms, investors, regulators, preparers, academics have got together and started to talk about the issues and talk about resolution of issues. And it may be because we're all in one place, i.e. in London, and we're all within half an hour's walking distance, but there has to be a will for people to actually engage with each other. And I think that in the UK we've been very fortunate that there's been that engagement. From my experience in Europe, that has not been the case in many parts of Europe, that there hasn't been that dialogue, there hasn't been that engagement. And the things that have been happening, as you mentioned, Chairman, this morning, the vote has taken place now, and so we've now got law in the European Union on many matters relating to the audit firms and auditor reporting and even wider, that a lot of the comments that were being made during the early parts of that couldn't be made by other jurisdictions because they couldn't see the future, because they hadn't had the dialogue. And I think it is so important that the groups do that, have that dialogue. And so I would encourage as much dialogue as possible in order to get all these groups facing in the same direction. I was also on, it goes wider than that, and it's looking to see what more you can deliver, what you can look at. And I was asked to be on a group for Sir David Tweedy's institute at ICAS. And there we were looking at assurance on management commentary. And this was before any standards. This started 2.5, 3 years ago. And the Scottish Institute got the groups that I've mentioned, but even put in the group with us journalists, financial journalists, and a whole spectrum of, and there was about 10 or 12, all from a different background, whether you were an auditor, whether you were an investor, whether you were a journalist, because they've got an interest and they've got an influence as well through financial journalism. And it was really looking at where the future was and what things might change. And I think just getting people talking and having that dialogue is so important if we want to get the right answer, because there's all different groups have different interests. And it's actually making sure that we try to take away some of the concerns, but also get to what, as much as possible, what people do want from all the various different groups.
And then, Liz, I didn't want to keep you out. In the United States, the fourth hitter in a baseball batting order is the power hitter. That's known as the cleanup. I wanted to get the three gentlemen on the record, but if there's anything you'd like to add in terms of I guess the bottom line, one of the bottom line issues is, do investors, from your perspective, know what they want in terms of the audit report and some of these issues we're dealing with?
Investors covers quite a wide population. I mean, it sometimes can be taken to include the sort of analyst population, whereas the investors that I'm representing are the institutional long-term investors, the people that put up the risk capital. And I think you will probably get a different perspective from long-term investors to analysts preparing sort of research reports. I think there's a different focus, as I think I outlined in my talk. But also what I would highlight in terms of investors' interest and their engagement on these issues, William mentioned the Stewardship Code in the UK. This was introduced into what is now the FSA's rules in December 2010, and we do, as an industry body, the monitoring on behalf of the FRC as to what adherence to the code actually means in practice. And what I would highlight is that in 2010 there were 80 signatories that are committed to stewardship and the code, and in 2013 there are just under 300. So investors are engaging on these issues, and they are reaching out to companies and auditors to develop that dialogue. Thank you.
The Chief Auditor has his flag up.
Thank you. I want to first of all share in the comments that the board members have made about the quality and depth of your presentations and comments, so thank you very much for all of that. Mr. Touche, in your commentary, you say a lot of the success of the regime in the UK is because at the same time as introducing a new regime for audit reporting, the FRC introduced new requirements for the board to report about judgments and estimates and other matters like that. No similar initiative is underway in the United States with respect to audit committee or board reporting. So if I could ask you to speculate a little, all of you, the auditors certainly speculate, since there's no similar initiative underway here, or if you didn't have a similar initiative in the UK, how would that have impacted your reports and your progress in terms of reporting, this extended auditor reporting? And then maybe Ms. Morell, from your perspective, what would be the perspective of the quality of the information you received if it was only the auditor report on the risk and material misstatement, but not commentary, at least from the audit committee, on significant judgments and estimates in financial reporting? So given that we don't have the two legs of this stool, how would you think it would be different?
I think it's quite tough, and I'm sure that's why you're asking the question. I think it is quite tough, and I try to draw that out in my commentary. I think the auditor can still comment on the areas of focus. The real question is, if the areas of focus are then commented on by the auditor in their report without findings, how are you going to get the findings presented and I suspect that you would find that behaviourally, if auditors do that, audit committees may well wish to comment on judgments in the MD&A or other areas of the front half. So I suspect these things will happen naturally without without the structure that we've been blessed with in the UK. Because and the question is around original information about the company and the company's conclusions. I suspect most companies would say, actually, we want to own the communications of those, and I think, from my perspective, that's right and proper.
Not much to add to what William said. I mean, absolutely agree with what he said. I mean, what we found in our initial survey was that, by and large, the issues that the auditor raised in the audit report were the same issues that the audit committee had raised. There are one or two differences, but generally speaking, you know, there was a commonality between what the audit committee said was really important and what they focused on, and what the auditors said was important as well.
Martin, I did say in my submission that I thought it was very important that the audit committee report does move along. It's interesting. The audit committee report that we had, 6 pages long, and it covered the work that we'd done as an audit committee. Interestingly, I signed it in my personal name as chairman of the audit committee. Just as William and Tony signed the audit opinion in their own name as auditors. And I think that is on about, you know, its accountability and all the things that we talked about, those things. And it would be interesting. I don't know what we would have done as an audit committee if the FRC hadn't said to us, you need to enhance the reporting, you need to do this, you need to do that. I get the sense, actually, because given the amount of engagement that we had with the auditors, we actually might wanted to write the story ourselves and put our perspective on it. You know, I can't say that that would be the case, but I just feel that, you know, certainly I'm very fortunate. I have some very good audit committee members, but I think that you know, the companies haven't come screaming to this table. They've actually embraced it, and Tony mentioned that, you know, this was a collaborative approach as far as the reports that they issued, and you know, Deloitte was the first with Nick Land as chairman of the audit committee at Vodafone, and that went before it was mandated. So I think that in the UK there is a realization that more needs to be done in reporting. It gave us a framework to work to from the FRC. But I actually think that we would have probably said more than we would have had to do, even if it wasn't there. And I think that is useful.
And then from your perspective, Ms. Burrell, what would be the value of the risks of material misstatement without the audit committee reporting on the judgments and estimates?
Well, I think if the auditors start to report on things that management has not reported on, I think ultimately it would drive management to report. Otherwise, they'd be seen as being, you know, dereliction of their own duties to set out their financial position and statement of performance. So I think there's a strong likelihood it would actually start to drive management to disclose that, whether or not it's the audit committee or it's disclosed elsewhere in the accounts.
Aware that I'm standing between this group at lunch, I want to observe that I was pleased to see in the ICGN letter to the IAASB a ringing endorsement of the point that naming the engagement partner in the audit report improves transparency and provides additional accountability that you believe will foster audit quality. One of the issues that we face and must wrestle with is how you know that investors will find information useful and why we think it's useful. Mr. Touche has, I think, written and spoken eloquently to the fact that the more information that is in the new FRC standard, one of the great benefits of that information being that it has improved a sense of professionalism and a sense of meaningful role for the auditor. There are other statements shot through that appear in various of your papers on this. We heard in one of the panels earlier that there's a lot of information that investors may want. Investors always want more information. Information increases volatility. And is it really information that protects investors, or is it merely information that gives them a desired or an imagined benefit? What I find striking about all four of your views of this subject is that first, you do not seem to me to insist that investors show that their protection requires a certain level of transparency and information. On the other hand, you seem sure that in your confidence that the information that is sought by the FRC proposal and the now European standards will benefit investors. And it would be very helpful to our thinking if you could instruct the board on how you know this is beneficial and how will investors make good use of the information.
So let me mention go back to the one piece of the FRC package that we haven't focused on, and that is that the company has to explain its business model and the risk inherent in the business model. So from the very beginning of the annual report, you get a flow focused on what the core business is, what are the risks and challenges. And by the way, we've also had a very clear mandate from the FRC that the annual report is not a marketing document, it is a report about stewardship. So it's supposed to have balance and be fair and understandable and all those other things. But you start with the business model, and then the accounting risks that we end up describing are those that flow from the company's business quite naturally. And if you start with that framework in mind, that is the essence of what the investors would like to understand further. So I hope that...
A couple of comments to add to that. I think the information through the audit report really has given the investors some kind of hook to discuss those risk areas with management, with the board, which it just never had before. So actually it enables them, the investor, if they wish, to have that type of discussion with management. And secondly, just an observation is that in 20-odd years of auditing, I've never had so much kind of interest from investors in what I'm doing, and sort of emails out of the blue from people saying this is a really positive thing, and much more engagement with investors as a whole, not on specific companies, but as a whole. And I can only see that as a real positive.
I think it's disappointing that if investors keep on asking for more, because what we do want is accounts that tell a story of management stewardship of the business, and we need cohesion between the front half and the narrative reporting and the back half and the numbers. And I think one of the requirements that the FRC introduced, which I think we very much welcome, is that the directors have to state that the accounts are fair, balanced and understandable. And I think that is a very good move, because I think in the past you could have taken a set of accounts, you could have ripped the front half away from the back half, you may have had trouble matching the two. So I think, we want accounts that tell a story, as to what management has done to the resources entrusted to it and exercised its stewardship, and that story needs to be cohesive, not full of clutter. So whereas there may be requirement, people may ask for other information, I think there is other information that could be disposed of in the accounts, like do we really need to have directors' remuneration regulations in the accounts? Do we need to have all the accounting policies when they're generally just a restatement of IFRS? I think these things could be looked at and we could cut some of the clutter. Thank you.
Again, with the profuse thanks of this board, this institution, for the distance you have traveled and the thought you have given to helping us with what is perhaps the most challenging and the most important standard-setting project that we have. Thank you, each of you. Thank you again, and it's been wonderful to have you here. We will adjourn for lunch, and we will reconvene promptly at 1. Thank you.